but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg, context changes everything.
Bit of a bounce this morning, up 0.4% on the S&P 500, fading some of last week's losses, taking a small bite out of them anyway. Last week, yields were higher by double digits. We had some more weight to that, of 5 basis points on a 10-year, 457.27. Under surveillance this morning, Fed officials urging patience.
I don't see urgency, and I see lots of reasons for patience. And over the longer term, I think my expectation is that we will ease, and that over the longer term, inflation, interest rates will be at lower levels. My baseline would still have us starting to ease later this year, but when I see is likely to be later than I had been previously thinking.
Here's the latest this morning. More Fed speak later on today from President Logan and Daly, as well as our interview with New York Fed President John Williams, 8:30 Eastern Time. Williams reacting to the latest economic data with retail sales due at the same time. PIMCO's Andrew Balls writing this: we believe that US growth has likely peaked and will gradually decelerate towards the rest of developed markets, yet the factors that have contributed to US resilience could continue to support the still slowing economy for a while longer. Andrew joins us now. Andrew, let's get straight to it. It's great to catch up as always, sir. What is behind that divergence, that US exceptionalism, the US versus the rest of the world?
I think part of it is fiscal policy. In the past, fiscal policy in the US has continued to provide a supporting role. I think part of it comes from the investment around AI, and I think that's been a positive factor as well. I think it continues to be really hard in the kind of post-COVID environment to figure out exactly where we're going to shake out here. But the other thing has been that there's been less impact from the monetary policy tightening in the US, maybe compared with more interest rate sensitive markets where mortgages are floating rate mortgages. So a combination of these factors, but it does look like you have this US exceptionalism compared with the rest of the world, and the recent data suggests that continues into this year.
Andrew, is that fiscal impulse a reason to avoid US duration?
I think overall, the level of US interest rates now, high quality bond funds in the US look attractive. So I think that fixed income here looks attractive in the US. But in terms of tactical positioning from our point of view, non-US duration looks like a really good complement. So the UK, Europe, Australia, Canada, the places where you can have a little bit more confidence, I think, that the slowdown has already happened clearly, and this can give you a little bit more confidence, I think, in terms of the inflation path. The strength in the US, remains an issue. The Fed needs to see some slowing down in terms of the activity in the US to be confident in terms of the inflation path. So overall, I think high quality US fixed income looks pretty good, but complementing this with the rest of the world, I think makes a lot of sense just in terms of the balance of risks. Maybe there'll be more ongoing US exceptionalism.
This is a bit of a shift for you, right, Andrew? I mean, a couple of weeks ago, you were quoted in the Financial Times saying you were looking outside of the U.S. for duration more significantly because of this concern about stickier inflation and higher yields. Are you saying that given the rise that we've seen, 4.6% or around that for a 10-year is fair value and you'd be a buyer here?
I think two things. I think the first thing, go back a month, the level of yields in the US looks pretty attractive. It makes sense to have the global diversification, the global duration positioning, but overall, I think the level of high-quality fixed income looks pretty attractive there. So there's a nuance. You like US duration and you like the rest of the world as a diversifier, and in terms of the balance of risks that we see there. Yes, then the second thing, as you alluded to, since we put on some of these positions, since we've been talking about this, the trade is moving in our direction. It was interesting last week with some of the repricing in terms of policy rate expectations. You weren't seeing that, say, for the ECB. So the trade has been moving in our direction. But I think at this point still in the global portfolios I manage, for example, overweight the rest of the world versus the US continues to make sense. But as US yields creep higher, then over time we'll need to reassess that.
There is a concern among a number of different investors that at some point this Federal Reserve is going to have to start thinking about rate hikes if we start seeing inflation remaining so sticky. How are you sort of gaming that out? Does that seem like something that you have to start factoring in?
I think that's a low probability in terms of the outlook for this year. I think that the Federal Reserve is clearly expects to be easing policy second half of this year. Chairman Powell has been quite clear on that, other Fed communications, but the market has been pricing out expectations in terms of rate cuts. We think appropriately there's a lot priced in at the start of this year, given what's been happening with the data. It now looks broadly fair to us. So I think it's a low probability that the next move is higher, but the closer as you reduce expectations in terms of cutting, then those risks just mathematically have to become larger in terms of how you think about it. And I think it's an important distinction. You have had the pricing out of rate cut expectations in the US, and this has gone along with a good performance in terms of equities, credit markets, more broadly risk assets. I think it would be more of a surprise, more of a market event were you to have a shift to expectations for rate hiking. So not our expectation. I think market pricing looks broadly fair for the US.
There's also a question about how much the rest of the world can diverge from the United States and from the Federal Reserve policy. Yes, the ECB indicated that they were sort of laying the groundwork maybe for a June rate cut. How far can that go given some of the currency reactions? I'm thinking, for example, of the yen, that's the weakest going back versus the dollar since 1990.
Right, so I think the yen is an interesting, important point. If you start with Europe, I don't think there's a great deal to stop the European Central Bank, the Bank of England, and others from easing policy. You are seeing differentiation across countries in terms of the GDP and maybe in terms of the inflation data. And these countries have gone through significant slowdowns, technical recession in Germany, technical recession in the UK, and so I think that there's not a great deal to stop them moving ahead. Again, market pricing looks pretty reasonable, and I don't think that the euro, say, in that context, is going to be a concern for the ECB. The Japanese situation is different in the sense that clearly the authorities have expressed concerns about the yen. It tends to be about the kind of the pace of the movement, not the level only, but there have been concerns expressed there, but it's not at all obvious that this is going to lead to any faster pace on the part of the Bank of Japan. So jawboning in Japan, keep an eye on that. In the case of Europe, UK, Australia, others, I don't really see anything significant in terms of currency markets which will hold them back. So a different sort of cycle to the ones we've had historically, but I think just greater differentiation across countries. And again, it makes sense for us to position for that in FX markets as well as in rates markets.
Well, let's talk about what that means, Andrew, just briefly. Does that mean additional dollar strength?
Well, I think that I think in particular the European currencies, given the path for the ECB and then given valuation, I think that something like Australia, Canada, the UK express this differentiation view using the interest rate markets. In the case of Europe, the baseline, the valuation not quite as attractive, but the FX, I think, position currencies like the euro, Swiss franc, Swedish krona, I think kind of a broad European beta underweight via currencies is a good way to position for, again, the risk of ongoing US exceptionalism. In the baseline, I think the US should slow down second half of the year. The Fed should deliver pretty much what's priced in terms of easing, but the balance of risks maybe is towards US exceptionalism, and so the FX positioning is another way to prepare for that.
Interesting. Andrew, this was brilliant. Thank you, sir. Andrew Balls there of PIMCO on the limits of central bank divergence and maybe pushing some of that through the FX market, looking for a stronger dollar. Lagarde last week, we're not Fed dependent. I think the governor of the Bank of Greece said it. It's time to diverge. Let's talk about how far they can go. Coming up very shortly, we'll catch up with Peter Cheer of Academy Securities, Terry Haynes of Pangea Policy, Tom Michaud of KBW, Marilyn Watson of BlackRock, the second hour of Bloomberg Surveillance. Up next.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
You've got very sort of mixed signals coming from markets, active risks in various parts of the world, including the Middle East. These are all risks that investors have got to take on board right now.
This is both a international and domestic story, but also very much a DC in-market story.
The 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward.
All this talk about rate cuts, and we remember the market does not care. The market has been concerned with earnings.
Ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Big couple of hours coming right up. Live from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance begins right now. In about 30 minutes' time, we'll get numbers from Goldman Sachs. 1 hour after that, U.S. retail sales. And don't miss this, an exclusive conversation. Mike McKee sitting down with the New York Fed President, John Williams. We begin this morning, though, in the commodity market. Down 0.7% on Brent, down 0.8% on WTI. New prices on the board here, Bramo, 84.98 on crude, 89.83 on Brent.
It could have been worse. That seems to be what this market is suggesting after a weekend of fireworks of more than 300 drones and missiles that were blown up before or in Israeli airspace by Iran. But this raises the question of, okay, what's next? This is not the last salvo, given the fact that Iran, for the first time, crossed Israeli airspace at a time where there are a whole host of conflicts that are brewing.
Norman Rule, to start the show this morning, the former senior U.S. intelligence official saying this is a new Middle East. Iran has indicated the matter can be deemed concluded. We're still waiting to find out whether Israel sees it quite the same way.
I don't think Israel is going to see it quite the same way, because they are going to have to respond to this existential threat, a red line that was completely erased with more than 300 drones and missiles sent over directly from Iranian soil. Brent McGurk, the Middle East director of the National Security Advisor for the president, said this to David Ignatius over the weekend. It was a worst-case scenario in what Iran launched, but a best case in terms of outcome. And that's why the oil market's taking a breather. But to Lisa's point, this might not last.
How and if Israel responds? We know based on reporting that the President of the United States reportedly told the Israeli leader, you've got to win, take a win. We'll see if he sees it quite the same way, as a win and a win he wants to take.
There's so much that can happen. From a market's perspective, it's very difficult to know how to price this. There is a question, though, and Nadia was very good with this, which is what is the risk premium that's currently being baked into markets when it's not just the Middle East, it's also Russia sanctions. There are a whole host of issues that could cause commodity prices to go even higher from here. How do we factor that in, given the fact that we are seeing inflation tick up and this economy handle, at least in the United States? This really creates a pretty unsettling backdrop for a market that already wants to pull back and rates that have already sold off.
It certainly feels like we've got a new floor for crude, just trying to work out how high the new ceiling might be in the crude market right now. We're negative by 0.7% on Brent crude at the moment. Just a programming note, John Kirby, the National Security Council Coordinator, joining us at about 8:20 Eastern Time, so don't miss that conversation as well. Just to get you started with the scores this morning on the S&P 500, positive by 0.5% on the S&P right now. Yields a little bit higher, taking back some of Friday's move. We're up by 5 basis points, 4.57. And there's your move in the crude market, down 0.8% to 84.96. Coming up this hour, we'll catch up with Peter Cheer of Academy Securities on managing geopolitical risk. KBW CEO Tom Michaud on bank earnings, looking ahead to Goldman in about 25 minutes' time. And BlackRock's Marilyn Watson on the prospect of much higher for much, much longer. We begin with our top story, market steady, as investors see little immediate risk of escalating tensions in the Middle East. Peter Cheer of Academy Securities detailing his game plan for managing geopolitical risk, saying he's neutral on rates, bearish on equities, and looking for a pullback in credit. He still likes energy. Pete's with us around the table. Pete, good morning to you.
Good morning, John.
You wrote about it over the weekend, the difficulty of pricing in geopolitical factors when there are multiple other factors taking place at the same time. How difficult is this moment?
I think it's incredibly difficult, right? There's so many mixed messages going on between what Israel should do, what Israel thinks they need to do. And I think we're now talking about this direct attack by Iran, but let's not pretend that Iran hasn't been directing or actually helping the Houthis and Hamas. So this is just a new evolution in this conflict, and I think it's actually going to get worse before better, unfortunately.
Talk to me about the weekend. You've got a whole host of generals on the team over at Academy Securities. What were they telling you in real time as this was developing Saturday night into Sunday morning, and how did they respond to it?
You know, I would say in some ways this was the best case, that it was a fairly telegraphed and relatively weak attack that was relatively easily defended. I think our biggest takeaway is really that so many other nations in the area helped shoot down the missiles and the drones. So I think that's an important takeaway, right? It's not that Iran has the entire Middle East on their side. They are still maybe a little bit isolated in their attacks on Israel. So I think that's one very positive, and that's got to weigh on how Iran thinks going forward. Other than that, though, I think it's very depressing, and I think one person said it, attempted murder is still attempted murder. So whether it was a successful attack or not, they did breach something that has not been breached before.
When you look at the Middle East waking up this morning, no physical supplies have been hit on the oil market. Oil continues to flow. So how concerned are the generals about other areas? Because we have seen these skirmishes in the Red Sea, but also the Strait of Hormuz.
I think we believe that we are really the only ones who can control the Straits of Hormuz, that Iran says they can close it down. That's fairly unrealistic. We think we have the capability to defend it. We can stop it. We are the only ones who can do that. So I think we're not too worried about that. Having said that, I think everyone realizes that Iran is shipping missiles to Russia. Some of those are coming off of EU sanctions and will be allowed. We still don't allow it, but again, that's not been something that's been easily enforceable. And I think the same is going to apply to oil, right? Oil is selling a lot, Iran's selling a lot of oil, mostly to China, a little bit to India. That's not been stopped. And it's very interesting when you look at the globe, right? It seems that there's less and less disrupting Chinese flows or Russian flows, and more, disrupting Western potential flows, not just in oil, but in goods and services. So that's a risk I think we're starting to face, and I think that gets worse.
And there's so many knock-on effects. So if the United States was to come out and say, start enforcing Iranian sanctions, prices would go high, and then Russia would actually have a higher premium to bring in more dollars. How do you view what the United States potentially might do? Do you think it's going to be more sanctions enforcement?
I think we're hoping not to have to enforce those sanctions. Again, if you go back even to what's going on with Russia and Ukraine, I think there's been some directives at Ukraine not to touch the Russian oil refinery. So there's a lot, I think, that's being played out in the oil markets. Go back to our strategic petroleum reserves. They were never really refilled either. So we have less kind of tools at our disposal to do this. And I think every incumbent's very worried about inflation coming in the election. This is, going on. And the one positive side to the energy use is that we're not talking enough about is I think as data centers get built out, we're going to have to use more and more electricity. That's going to drive domestic demand. And you look at the success India's having in terms of their growth. So India is starting to become a bigger and bigger consumer of commodities. So I think there's a lot of commodity pressures coming from both positive factors and then all these risk factors that I don't think are fully priced in yet.
So you have the privilege of taking all of this and trying to come up with some sort of market thesis. How has it been?
It's been very tricky. I think, it's been very helpful because the one thing is it does help us kind of get below the fold, right? These generals have experience in the region. They talk to IDF commanders. They know what they would have done. Many are still plugged into D.C. So I think we've got a pretty good read of what's going on. Having said that, that just takes out a lot of the noise. There is still a lot of range within going on, and it's very hard to figure out how these various countries are going to respond. And reality is we've never probably quite so publicly, quite so directly told Israel what we want them to do. And how are they going to behave with that?
But just shifting away, there's so many other stories, as you mentioned. There's the earnings story with the question of valuation. There's something that you pointed out. There's been almost no consistent pattern between rates and stocks. How are you sort of shifting your understanding of how high yields can go and what the stock relationship could be, given that earnings so far are inconsistent at the very inception of earnings season?
Well, it's interesting that you asked that because pulling up today, two top stories on Bloomberg are about Tesla having to lay off some people and Apple's sales in China. And again, going back to our theory has been that China is going to try and more and more aggressively sell their brands globally, suppress sales of our brands domestically. And I think that's something we're not yet facing is this potential earnings pressure and margin pressure U.S. companies are going to face as China sells their brands. I keep coming back to BYD. I literally never really knew what a BYD was 2 years ago. To me, it was always Boyd Gaming. That was the ticker symbol for the stock. And now it's this EV company. And they don't yet sell EVs in the U.S., but you see this kind of pressing across the globe. And I think that's where the retrenchment's going to come is what do we do as we face competition from Chinese brands? That's a risk that's just starting to filter into the market. And I think that's going to put pressure on stocks.
Pete, another reason not to like stocks. So let's talk about what the haven is. The optimal haven is always defined by the nature of the dominant risk. What is the haven right now with that in mind?
I still like commodities and energy. I think that's a growing use, again, even within the U.S., right? As we build out these data centers, talking to people who build the data centers, getting access to the power needed to power these data centers is one of the biggest problems they're facing, and where do you cite these, where do you put these, and it is going to be a domestic phenomenon. I think we mentioned before, but more and more companies are realizing if they're going to be processing their data, if they're going to be using AI, you want to be doing it on domestic soil with domestic people, because it reduces, doesn't eliminate all the cyber threats, but it does reduce that. So that's a growth area, and all these put pressure on energy. I don't think yet we're seeing anywhere near the potential disruption we're going to see in the Middle East and elsewhere. So that's where my favorite.
Let's just finish on that disruption just briefly. You've got quite an original view on this. You believe that hot wars like the one we're seeing take place in Ukraine and again in the Middle East is a reason not to like treasuries. Can you just build that out just a little bit?
Yeah, and again, briefly on Friday, we had that traditional flight to safety, right, where treasuries rallied. But I think this time it's going to be very different, because reality is everywhere these hotspots are, it's going to affect oil prices. It's going to affect oil prices potentially dramatically. We have fewer things that kind of combat that near term. And I think people are going to realize, oh my gosh, we all need to spend more on defense, not just us, but Europe, everywhere. So all of a sudden the conversation is going to be like, oh, this is bad for global trade, which is already deteriorating, but it'll switch too quickly. Oil prices are going higher, commodity prices are going higher, and everyone's going to run bigger budget deficits. And given positioning on where we have been in yields, I think we can go higher. Now, we kind of hit the high end of my range, 460, so it's hard to be like pounding the table bearish anymore. But I do think there's much more risk of getting to 5% than 4%.
Interesting. Pete, thank you, sir. Deeply thoughtful stuff, as always. Peter Cheer over at Academy Securities. Brent crude right now, 89.82. We're negative 0.7%. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. As Peter mentioned, Tesla is set to cut more than 10% of its global workforce. The car maker is grappling with a slowdown in EV demand. Those cuts would be more than 14,000 employees. In a letter to employees, Elon Musk cites a duplication of roles and job functions in certain areas. The PE giant CVC has revived plans for an IPO in Amsterdam. It's seeking to raise at least 1.25 billion euros. Its investors in a listing that potentially paves the way for other PE firms to go public. The Biden administration is planning to award Samsung as much as $6.4 billion in grants to increase chip production in Texas. All of it is part of a U.S. effort, the idea being bolster domestic semiconductor manufacturing. The money will also be used to expand Samsung's existing facility in Austin, Texas, and it will support U.S. aerospace, defense, and automotive industries, according to the Commerce Department. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Up next on this program, Trump slamming Biden on Israel.
We were respected 4 years ago all over the world. Today, we are considered a joke. Ukraine would have never happened. Israel attack, both October 7th and today, would have never happened.
That story up next, live from New York City this morning. Good morning.
Could face bigger challenges. Wilson was elected.
Was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Let's get you over to the price action. Equity futures on the S&P 500 positive by, let's call it 0.5% on the S&P. Yields bouncing back by 5 basis points, 457 on a 10-year, and crude a little bit lower, negative 0.8%, 84.94. Under surveillance this morning, Trump slamming Biden on Israel.
Before going any further, I want to say God bless the people of Israel. They're under attack right now. That's because we show great weakness, and it would not have happened if we were in office. You know that. They know that. Everybody knows that. We were respected 4 years ago all over the world. Today, we are considered a joke. Ukraine would have never happened. Israel attack, both October 7th and today, would have never happened.
It's the latest this morning. Former President Donald Trump claiming the weekend's events would not have happened if he was still in the White House. Today, he'll be in court, the first president to sit for a criminal trial. Bloomberg's Katie Lyons joins us now here in New York City for more. Morning, Kaylee.
Well, good morning, John. This is going to be a historic day. As you mentioned, this is the first time a former president of the United States will be in a criminal trial. Of course, in this case, brought by Manhattan District Attorney Alvin Bragg, he is charged with 34 felony counts of falsifying business records. The allegations essentially that he illegally concealed payments to porn star Stormy Daniels and hush money in the days before the 2016 election. Now, Trump has denied all of these charges. We could, at some point in this trial, actually see him testifying, taking the stand himself, and we also expect potential witness testimony from Stormy Daniels herself, as well as Michael Cohen, who the former president's former attorney and fixer. All of that, though, will come later. What really starts today is jury selection. They are going to do the hard work of trying to find 12 jurors who can be unbiased and fairly judge former President Trump in this case. Of course, he has very high name recognition as a former president and current Republican presumptive nominee, so they will be asking them questions as to, like, whether they have ever attended a Trump rally, whether they have a true social account. This is a process that could take some time, potentially 1 to 2 weeks. The trial in total could take up to 8 weeks.
Kaylee, what are the political implications for today? Because when we poll voters, what they say is that they do like Trump, but potentially they sour on him because of the legal issues.
Yeah, certainly we have seen that in January. Bloomberg did a poll with Morning Consult that found in the 7 swing states that are likely to decide this election, more than half of voters say they would not vote for Trump if he were to be convicted of a crime. Now, of course, being convicted of a crime doesn't actually prevent him from running or even obtaining the presidency, serving as president, but it could change the minds of voters. The other thing we have to consider is that Donald Trump will be here today. He has to be in the room for every day of this trial, which will take place every weekday except for Wednesdays, for, again, a period of potentially up to 2 months. That will take him off the campaign trail. It also will cost him a lot of money, millions of dollars in legal fees that could impact financing for other campaign-related events. But what we have seen historically is that Trump uses court appearances like the one we will see today and then the weeks that follow to galvanize his base, to kind of use it as a way to obtain free media, plead his case, not just that he feels this Department of Justice is being weaponized against him and intended to keep him off the campaign trail, but also talk about really whatever he pleases. This is the strategy that has worked for him thus far in his presidential campaign, but we'll see if things start to change, as potentially we could see him ultimately be convicted of a felony here.
Katie, looking forward to your coverage throughout today on Bloomberg TV and radio. Katie Lyons there here in New York City. With us now is Terry Haynes of Pangea Policy. Terry, compare and contrast the president in the Situation Room, the former president in court. How's this playing out with the electorate?
Well, I think it's generally not a good look for Trump. The bottom line on Trump right now is that he's struggling to try to unite the party, and my prediction is that he won't, and I think can't. And at the same time, he's already underwater with independent voters. He needs a unified party, and he needs a majority of independents to win, as he did in 2016. I tend to think, on balance, this drives people away. At the same time, Biden's got a terrific opportunity, in a political sense, to come out, not only look like a leader, but be a leader and unify his party, attract independents by, frankly, being strong and resolute and showing a lot of energy. And we'll see if that happens.
Terry, we know that Donald Trump has been speaking with House Speaker Mike Johnson about potentially next steps when it comes to either providing financial aid to Israel and or to Ukraine. Do you have a sense of what that influence does to the likelihood of getting something through this week?
Well, I think all it does, Lisa, is let me start here. what the House is going to do this week is very much up in the air. Let me just say that. Secondly, they're very focused on Israel. Thirdly, if I were the vast majority of members in the House who want Ukraine aid, I'd be rattling the saber on a discharge petition very hard. You saw new current member Tom Suozzi go out with this in the Wall Street Journal, saying, the time is now to unify around, doing something on Ukraine. So, I think what's happening here is that Trump's probably got Johnson's back on the alternative ways to fund those things, the kind of lend-lease plans and other forgivable loans and the other sorts of things that have been bandied around, and it kind of puts it puts the opponents of that, the Greens of the world, kind of on the back foot.
What do you make of the fact that President Biden was so quick to say that the U.S. would not support Israel if they retaliated in any way against Iran?
Well, your word this morning is contained. Mine is restrained, and I think that's a restraint. I think it would be naive to expect Israel to make no response to this, but it is going to be proportional in the Western sense of how we understand that. Iran's response, of course, wasn't proportional, which is one of the things that has caused the current problem. I think what you've got here is you've got a very ad hoc coalition, as Norm Rule said in the last hour, that's going to take things more or less on a case-by-case basis. There's a lot of encouragement, though, and in how and why people responded, and not least among those was the way that Jordan stepped up to not only defend its own airspace, but to send a message that there are greater interests in the Middle East than Iran, and they're going to defend themselves and defend those interests as well. That was all very good.
Terry, you say that the president could make a win over this domestically, can look resolute, can talk about being a strong leader. But the fact of the matter is, Biden told Iran don't, Iran did, and the president is telling Netanyahu reportedly to take the win. How does that exude confidence and strength?
Well, that's a very good question, and the answer is I don't think it does. I went out to markets pretty strongly on that point yesterday. This is an administration to me that's been defined by the straddle. My 2 cents of unwanted advice to the Biden White House is they'd be better off not straddling and better off talking about what they're for, how they're for, and what they're trying to do. They will not only get stronger support from broad swaths of the American public, but even those who disagree will respect the idea that they're pushing in a particular direction and doing things in a particular way. You can't have this always, and the last 3 or so years, I think, is fresh examples of that.
Terry, why do you think the president left for Delaware before these strikes that the U.S. was preparing for? And I'm curious because I want to know what this administration is learning or potentially not learning. Biden did this as well when he went to Camp David when Kabul was falling. Why continue to leave the White House when you're trying to project this image of strength?
That's a better question for Admiral Kirby than for me, but I think what they do is assume that things are normal until they're not, and they want to project the image of normality until things aren't. Frankly, it also, the president's plugged in from anywhere in the world, so where he is doesn't completely matter in terms of fulfilling his own duties. But the visual is it attracts, it's a little bit more dramatic and shows him energetic and on top of things, and they probably consider that as well.
Terry Haynes, thank you, sir, of Pangea Policy. I'm sure if we ask, we won't get a good answer, but Anne-Marie might try. In about 1 hour's time, we'll catch up with John Kirby, the National Security Council coordinator on the events over the weekend. In about 5 minutes' time, 6 minutes' time, we'll catch up with this guy, Thomas Show of KPW, the CEO, on bank earnings. Goldman Sachs numbers about 6 minutes away. Big bank earnings kicking off on Friday, Bramo. Then we push forward to tomorrow, I think. We get Morgan Stanley and the likes of Bank of America.
The expectations are actually higher for Goldman Sachs than, say, before we got some of the JP Morgan, Bank and Citigroup earnings, just simply because banking revenues came in significantly higher, and there's this expectation of the IPO calendar and debt issuance coming in stronger. So a lot of people are going to look at how Goldman Sachs capitalizes on that.
What did you think of the gloom being outgloomed by Jamie Dimon over at JP Morgan? If you missed it Friday, this quote: "The global landscape is unsettling. Terrible wars and violence continue to cause suffering, and geopolitical tensions are growing. There seems to be a large number of persistent inflationary pressures which may likely continue." Some comments in the mix as well on QT, quantitative tightening. "We do not know how these factors will play out."
This is just a bank that is sort of making incredible revenues, right? So they just did deliver incredible revenues, albeit with net interest margins that didn't exactly wow anybody. But on the other hand, they're looking at companies that are trying to straddle, that's the word of the day, I guess, straddle some really challenging moments. I think that right now, that's what we're going to hear from a lot of executives.
I was a slight cynic when I saw Jamie Dimon come out with that, because everyone was focused on the stock, the market was focused on this net interest income. That didn't get to the place that they wanted to, and yet he's like, but actually, there's more concerns over here.
We're focused on the numbers from Goldman. First quarter fixed sales and trading revenue, $4.32 billion. The estimate, $3.64. So that's $4.32 against an estimate of $3.64. That's a tidy upside surprise. First quarter net revenue, $14.21 billion. The estimate, $12.98. We'll get into that beat in just a moment. That stock is up in the pre-market by more than 2%. We'll catch up with Shonali Basak in just a moment, and Tom Michaud of KBW.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried had pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Goldman Sachs looking pretty good this morning. Here's the stock price. The market action looks like this. We're up 3% in the pre-market. Sales and trading beat. Investment banking beat. Advisory beat. Shanali Bastic, it's hard to find a miss in this report this morning.
There are almost no misses in this report. And when we say they beat by a lot. You look at their return on equity, for example, they came in at nearly 15%. The market was expecting 11%. You look at fixed income trading, it more than doubled from the prior quarter, and it beat JP Morgan on equities, coming in above where Morgan Stanley is expected tomorrow. They not only beat their expectations, they set the bar higher in all those traditional investment banking businesses. And remember, John, Goldman coming into today was trading at a lower price to book ratio than all of its investment banking peers, besides, of course, Citigroup.
Let's take one line, fixed sales and trading revenue. You went there, 4.32 billion. The size of this beat, the estimate 3.64. Is the pie getting bigger, or have they just taken someone else's slice this quarter?
Well, that's interesting you ask, because of course we've lost some banks in the last couple of years in this business. But remember, Goldman is sending out a calling card, and that is we're willing to lend. We're willing to lead with our balance sheet. It's not just about the idea of volatile markets here, it's financing. They had a record quarter of FICC financing, as well as the second largest quarter ever in equities financing. And so you're looking at Goldman leaning in more on those traditional businesses and saying, remember that consumer foray? We're almost done with it. A lot of those figures, those messy figures that you used to see in that front page for the last year or so of Goldman, that is almost gone. It's in the tens of millions now. They're cleaning up their act, and they are leading on the businesses that they've always known best.
Basically going back to the bread and butter rather than the consumer banking and some of the other issues. Can you give us a sense, just to sort of put this in scale, what stage of the reboot is this for David Solomon as he tries to reorganize and refocus Goldman Sachs?
Well, there's one big question, and you were asking, is there any misses? There's one slight little miss, and that it's an asset and wealth management. And so as Goldman shifts the firm here and focuses on banking, investment banking, trading, they are also trying to show the street that they're almost a $3 trillion asset and wealth manager as well. Now, record assets under supervision, but how do they keep setting that bar higher? They have new management there, and you know that miss is very much attributed to the changes you're seeing in the asset and wealth manager. They sold some businesses there too, but the sustainability of that business is going to help it try to get that Morgan Stanley premium that's existed over Goldman for the last couple of years.
You've mentioned Morgan Stanley a few times now. They report tomorrow morning. Do you think there is a read-through from this into them tomorrow?
Well, like I was saying, the bar is very high now for equities trading for Morgan Stanley. Remember, Ted Pick taking over, that was his business, John. And so what I'm hearing on the ground is that he's been pretty aggressive there and trying to take back that share that Goldman has gained in the last couple of months.
Stock is up by 3.6% at the moment, at least. Elsewhere, looking at Morgan Stanley, the stock is up by about 1 full percentage point in the pre-market. Morgan Stanley reporting tomorrow morning. With us around the table, together with Shanali, KBW CEO Tom Michaud. Tom, you've had a few minutes to go over this one. What's your reaction to this?
So our feeling is it's two things. One is it's what's happening in the industry. So there is a rebound that's happening in investment banking. Investment banking was on a real downturn over the last prior 12 months. And what you see at Goldman is not even full power. I mean, we still think the industry, broadly speaking, is probably operating around 70% of what we would think is typical. So as we put the COVID period behind us, get to a more traditional moment, as IPOs pick up, M&A comes back, and especially if we get lower rates, we think the business has even further to go. So that's number one. Number two is, I think it's a big moment in the Goldman reboot. They also sold Green Sky in the quarter, which is putting some of their consumer efforts behind them. And they're going to focus really on what's been the core of the company over the long term. We've been really positive on the shares. My sense is we'll continue to recommend it even after today's move. And as the company earns around 16 on tangible common equity in this quarter, it's a signal that they're starting from a very healthy point, even this reboot.
Something that Shonali said that really stands out, because it seems like a lot of banks are implying the same thing in their numbers: use of balance sheet. We're hearing that again and again, using their balance sheets more aggressively. Is this the new model, kind of going back to the old one as they try to compete with private credit and private asset managers? They got to use their balance sheets, and they find ways to do it even with all the regulatory capital.
Well, I think that that's going to be key, because we've just gone through a moment where the banks in general have lost market share to non-banks. And I personally believe in a 5% yield world with a flat or inverted yield curve, it's going to be harder to get financing than when money was free during COVID, okay? So having access to a balance sheet that's reliable is going to become more important to banks' clients. And over time, it could be part of the moment that helps these banks regain some share from that moment in time.
Forgive me, there were years when a lot of these bank executives were saying that they can't do this, that they are hamstrung, their hands are tied because of financial regulations. What changed?
Well, believe me, I don't think any bank's going to step outside of the financial regulations. I think it's just core blocking and tackling, which is having reliable access. I think what's changed is the other markets aren't as easy. So zero interest rates meant that it was very easy for non-banks to be able to raise financing, to be able to enter the market. It's going to be harder for non-banks to raise funding to serve bank customers. So I think that's what's changed. Not the banks, but I think it's the other items and other conditions.
You said you like Goldman Sachs. Shonali was talking about how Ted Pick, his whole business has been really the trading, and potentially we'll get read through Morgan Stanley tomorrow. What other banks do you like?
Well, we like Truist very much. It's one of our favorite ideas. It's one of the biggest banks in the nation. They sold their insurance broker for a whopping price recently. They're going to trade, and what you don't see now is that they haven't put the gain into their financial statements yet. So the stock's really trading around 115 a tangible book, which is a very low valuation for one of the best banks in the nation. It's got a 5.7% yield. The next time that dividend changes, it's going up, not down. So our view is at a single-digit PE ratio for a bank that's got one of the best franchises in the country. That is, I would say, our largest bank idea at the moment, and we're pretty bullish on that one. And then, they're also doing a restructuring. They got a little bit off sides after their merger, and we think the new management team is very focused on fixing things.
When you look at the loan market at the moment, what do you make from it? Because I know in your notes you talk about the seasonality of it.
Slow. It's slow. What we're seeing in all the results that have come out, loans have actually been a little bit lower than we expected. And when I watch, look, we've had 3, now 4 banks report. Our firm files 225. We got a long way to go. But what do I think? I think delay in the pivot. So our bull case on the stocks, and we're market performed, so the bull case, we're pretty balanced. But the bull case is that we're going to get a pivot and acceleration into earnings going into 2025. To the extent that we get less rate cuts, less growth, it probably pushes that back a little bit for when we see an acceleration in earnings.
How aligned are you with the gloom of Jamie Dimon over at JP Morgan? What did you make of the caution from him on Friday? Typically, we're all used to sort of beat and raise from JP Morgan. Then on Friday, things kind of changed. What do you make of that?
There are still big macro risks in the marketplace. And I'll tell you, when I talk to bank management teams, it's almost like I feel like I'm having a credit analyst discussion more than an equity analyst discussion. They're very focused on their own balance sheet. I think strength and stability seems to be a bigger presence in the strategic boardroom of these banks. They are building these banks to make sure they can withstand any challenge.
Hey, Tom, if you look at the way Goldman and Morgan Stanley have been trading, they've been bears. Morgan Stanley is down more than 7.5% over the last 12 months. Does it deserve that? Are these kinds of investment banking and trading businesses just something people don't want to pick up on in this environment?
I think for Morgan Stanley, it's just a preference for Goldman Sachs for us. We had been really bullish on Morgan Stanley. We pulled back. It's just the dynamics of what's happening in their own earnings at the moment. We just think there's more upside because there's more delta coming at Goldman. They can do a little bit more self-improvement, and so we like it more. But so we're market perform on Morgan Stanley, but think it's a fine company. We just think the dynamics don't have as much delta to them.
Shonali Basak there alongside Tom Michaud of KBW. Just looking through the numbers just to wrap things up, Shonali, quickly. Beat. How would you frame it any other way for Goldman Sachs this morning?
There's no other way to frame it. Remember, they've only been trading at 1.2 times book value heading in today. Morgan Stanley's at 1.5. It sets the bar super high for tomorrow. And remember, there's a big cloud over Morgan Stanley with a lot of questions about the investigations that they're facing. They haven't said anything yet. And so the earnings are one thing, but then the story is also going to be equally important headed in tomorrow.
Let's get the scores up on the board again and just look at Morgan Stanley going into earnings tomorrow morning. In the pre-market, it is positive off the back of what you're seeing on Goldman Sachs. Goldman up by 3.4%, just beats across the board. And we talked, Lisa, briefly about the nature of the upside surprise. Let's just sit on fixed sales and trading revenue just for a beat longer. 4.32 billion, the estimate 3.64. That is a solid beat.
And it really raises the question, okay, they're using their balance sheet more, so that means they're making directional bets or taking things down in a market that might look like it's liquid, but may not be as liquid. And then it also raises this question about just how much they're taking share from some of these other companies, just in terms of private asset managers, which is something a lot of people have talked about.
But also to remember, we don't have Credit Suisse anymore. So a year ago, Credit Suisse disappeared overnight into UBS. So when you look at the statistics, I believe that market share was pretty much captured by many of the biggest other banks. So I think that's also, on a year-over-year basis, been somewhat of a boost.
So when I asked Shanali, is the pie getting bigger, or did they just take someone else's slice? Are you saying that slice belonged to Credit Suisse?
I would say amongst probably others. I would say they're getting a bigger piece of the slice because while I do think, and I think Morgan Stanley will benefit tomorrow from the market just being better, and believe me, as someone who operates an investment bank, I pay attention to league tables and market share, believe me. So the biggest firms have probably picked up the most share, and it's a few firms who have done that, and Morgan Stanley and Goldman would be in that bucket.
What's good for Goldman Sachs isn't necessarily good for Zions Bank, for some of the others that are smaller regional banks. How much is the gain of big banks the loss of regionals?
Well, they tend to do different things. So the net interest income world that they all live in is somewhat similar. It's the investment banking piece that really is the big delta that we've been talking about. So as we get away from banks that report that don't have that, they're going to be more attuned to what's happening in the interest rate environment. The good news there, though, Lisa, is that 6 months ago, we would have been talking about the quantity of deposits. It's all about deposits, the quantity of deposits. The nice thing is that pressure has eased, and you're already seeing it in the numbers. Now it's the cost of those deposits. And we're waiting for the Fed to cut rates a little bit to take some of the heat off, because you know what? U.S. Treasuries are really competitive for bank deposits. We need the U.S. Treasury rate to back off a little bit for the banking industry to do a little better. And it is actually all about deposits more so than loans.
When you say we're waiting, you mean the banks, because for the rest of us with money on deposit, we're not. We're waiting for them to pass on higher interest rates
T-bills,
for the final time. You know, make it happen.
Online, it's easy to do.
I'm so lazy, Tom. Tom Michaud, thank you, sir. Shanali Bassett, thanks to you too. Goldman Sachs in a pre-market positive by something like 3%. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. German Chancellor Olaf Scholz has begun his second visit to China. He's expected to say that Beijing has not acted on Europe's warnings to end discriminatory business practices. Scholz is also expected to question Xi about China's support for Russia's war machine. Bitcoin is set for its fourth halving. Around April 20th, the amount of Bitcoin that miners can earn each day will be cut in half. It's a process that usually supports prices, but this time a $10 billion blow is expected to crypto firms based on current prices. And it is the 128th Boston Marathon. It kicks off today. The city sees a $200 million economic windfall, which would be the largest bump ever for the event since the pandemic, at least. The marathon is set to welcome 30,000 runners who will be competing for a title and a prize of $1.2 million. That's your Bloomberg Brief, John.
Good luck to them. Couldn't do it. We won't be one of them. I think David Kelly, JP Morgan Asset Management. Is David running that this morning?
I'm not sure whether he's running that. He has run, though, I think something like 9.
I think he told us last week he was running that. So, David, if you're watching or preparing for that, good luck, sir. Up next on this program, pushing back rate cut expectations.
I think that the Federal Reserve is clearly expects to be easing policy second half of this year. I think it's a low probability that the next move is higher.
That debate up next, live from New York. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Let's kick it off with the banks. Goldman Sachs doing better than good, a beat across the board. Goldman in the pre-market positive by 3.4%. The read across for Morgan Stanley, apparently looking for more of the same tomorrow morning when they report earnings. Lisa, Morgan Stanley up by 1.3%.
It's interesting that Bank of America is still yet to report earnings. It hasn't had the same kind of boost. This really speaks to the dominance here of the investment banking industry, that this is sort of the revival that people have been waiting for. Goldman Sachs cashed in. The expectation implied here in the market action is that Morgan Stanley will too.
Tomorrow, the focus turning to Morgan Stanley and BofA. They report tomorrow morning. If you are just joining us, this is a setup this morning. The scores look like this on the S&P 500. We're positive by 0.55%. Equities pushing higher. In the bond market, yields pushing higher as well. We had this risk aversion on Friday, just classic risk-off move. Bonds got bought. Yields lower. We're unwinding some of this price action. Yields up by 6 basis points, 457.89. And in sympathy with some of that, Bramo, we're seeing the move in crude unwind on Friday. Some risk aversion going into the weekend, understandable. We're backing away on crude this morning, down by 0.8% to 85.
It could have been so much worse, and a lot of people were looking for the potential for some sort of further escalation. Now it's all about contained, as you've been pointing at. This question, though, of the Treasury response and whether Friday was actually a read-through to the haven status of this instrument is a real good question that still is out there.
Two things on the agenda for the next hour, 8:30 Eastern Time. We'll get U.S. retail sales. After that, immediately after, an exclusive conversation with the New York Fed President, John Williams, sitting down with Bloomberg's Mike McKee. Under surveillance this morning, pushing back rate cut expectations.
I think that the Federal Reserve is clearly expects to be easing policy second half of this year. The market has been pricing out expectations in terms of rate cuts. We think appropriately there's a lot priced in at the start of this year, given what's been happening with the data. It now looks broadly fair to us. So I think it's a low probability that the next move is higher.
It's the latest retail sales data coming at 8:30 Eastern Time. The latest read on the state of the consumer as inflation continues to run hot. Investors betting on just 2 rate cuts this year, beginning in September. Marilyn Watson of BlackRock saying, quote, "We had expected this to a certain extent. With market pricing of U.S. interest rate cuts looking very aggressive at the start of the year, we believe it is possible that the Fed may at the earliest begin to cut rates in June, but there is a lot of data to absorb before then." Marilyn joins us now to talk about this just a little bit more. Marilyn, let's talk about some of the calls on Wall Street, some big changes. Deutsche Bank pushing things out to December. Mike Gapen at Bank of America, they go from June all the way out to the back end of this year as well. Marilyn, why haven't your expectations changed quite so much relative to the incoming information of the first 3 months of this year?
Yeah, good morning.
Obviously at the beginning of this year, there were very, very aggressive rate cuts priced in, which, almost 7 at the beginning of the year, 6 or 7. Now the market is pricing in actually, less than 2 if you look at Fed funds futures. I think, we think it's reasonable to still expect that there may be a couple this year, but there is a lot of data to come. It's possible that they may cut in June, but I think, throughout this year, the Fed has been emphasizing in its communications over and over again that they want to see more data, that they are data dependent. And I think particularly when you do look at the economic data that's been coming through, it has been very resilient in terms of economic activity, in terms of the labor market, which is cooling, but has actually, remained, surprisingly strong, I think, for many observers. And then, of course, when you look at the inflation data, and obviously the Fed has a dual mandate, when you look at the inflation data, then actually it has remained above consensus expectations, for the past 3 months, particularly if you take the CPI data last week. When you look at the services component of the inflation data, then that really is the component that's actually supporting and keeping inflation higher than expected. So I think we did expect at the beginning of this year to see rates higher for longer. And so we do still think that it's, highly likely that there will be some cuts this year. But, I think 2-ish is probably pretty reasonable at this point.
Based on the inflation that we've seen and based on the fact that a lot of the geopolitical tension seems to go directly into higher prices for commodities, how much can treasuries really serve as the haven play in the same kind of way as they have in the past?
Yeah, I mean, that's a really interesting point because we have seen treasuries to a certain degree, as you mentioned last week, maybe on Friday, acting a little bit like a safe haven, but then, as you say, they've repriced again now. And I don't think that they're acting the same way that we would have seen in previous similar geopolitical event-type risks or in previous cycles as well. We are seeing obviously more of an emphasis on commodities. And I think at the moment, the market just doesn't really know what to expect. No one really knows what's going to happen next. And so I think at the moment, they're sort of looking through what's happening in the Middle East again and really still focusing on what they think the central banks may do, what they think in terms of the economic situation, both in the US, but also in Europe and elsewhere. And we had some more encouraging data out of Europe today in terms of industrial production and things. So I think the market doesn't really know how to price, the unknowns in the geopolitical sense. So there's just really, again, focusing on the data and on the markets as they see them at the moment.
It seems like the word of the day, at least when it comes to fixed income investing, is divergence, and about the divergence between the ECB and the Federal Reserve, the ability to cut rates in Europe, the divergence with Japan, which has been on its own planet when it comes to some of the rate policies. I'm wondering how much you're on the same page with Andrew Balls, that you're not necessarily avoiding U.S. fixed income, but that you're trying to diversify increasingly to areas that are on a path to cut rates more aggressively this year.
Yeah, so we do have a very, very diversified positioning in our global unconstrained bond fund. We do continue to like, U.S. investment grade in particular. We like, getting some very decent carry, particularly sort of at the front end of the curve in the U.S. where there isn't that much interest rate risk, but you get some, particularly in a lot of the corporates, you do get some very attractive carry. We can just clip the coupons there. But we are also very diversified. So we have positions in European investment grade, for example, where, again, particularly in terms of valuations, when you then hedge them back to the dollar, they're very attractive. We also have positions in Spanish duration. We have positions in Asia as well, also in securitized assets in a variety of those. And we also have positions in emerging markets as well. And I think in this environment, given the divergence that we've already seen, given the repricing we've seen across fixed income markets, then now we can also see a lot more attractive opportunities when we're focusing on a bottom-up perspective. So now you do have a big price differential that we didn't have a couple of years ago in terms of, two potentially similar corporates, but, have very different, underlying fundamentals. And so, at the moment now, we do think there are a lot more opportunities for active fixed income managers, really looking at it from a bottom-up perspective, as well as looking across markets, so comparing some emerging markets to some, developed market investment-grade bonds and likewise. So now I think being really, focusing on our high conviction views from a bottom-up perspective, but also making sure that we're, managing liquidity, managing risk, and really understanding that, in this environment where there is, a great deal of uncertainty, both in terms of, central banks, but also in terms of geopolitical events as well. We want to be nimble, we want to be flexible, and we want to really understand where the income is coming from in our fixed income portfolios and, the liquidity component of that.
Marilyn, wonderful to get your perspective. It always is. Marilyn Watson there at BlackRock. Lisa talking about the extent of central bank divergence we can expect, the limits of it. I think we heard a lot about this last week from the European Central Bank. I talked about comments from President Lagarde, who said we are not Fed dependent. Then we had the Bank of Greece governor speaking to Bloomberg saying, now it's time to diverge. Okay, by diverge, do you mean one rate cut and the Fed holds? Or do you mean 100 basis points of cuts and the Fed does absolutely nothing for the rest of the year? Because they're two very, very different stories. And if you're going to push this through the FX market, like Andrew Balls of PIMCO suggested, are we taking euro dollar to 105? Are we taking it to parity? Does that happen with crude rallying another 5 to 10% because of things in the Middle East? I think it's too simplistic to sit here and say you can diverge and then start to talk about the extent of that divergence without really understanding a whole host of issues that surround all of that.
Very well said, especially with respect to oil prices. And this is something that we've heard, that ultimately a weaker currency for Europe isn't that big of a problem unless you start to get that surge in oil prices, which we're already starting to see. And then it becomes somewhat more difficult. And that seems to be what a lot of people are trying to game out.
You get a double whammy of crude back in triple digits and euro dollar back at parity. How many calls are we going to hear about central bank divergence in Frankfurt, Germany?
Suddenly that's going to go out the window.
Yeah, I think that might change pretty quickly. Coming up in the next hour on Bloomberg Surveillance, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to the National Security Council Coordinator, John Kirby. New York Fed President John Williams joining us, speaking to Michael McKee exclusively following US retail sales. And we'll break down that number with Tom Porcelli of PGIM. If you are just joining us, equity futures positive here by 0.5% on the S&P 500. Yields are higher too, up 5 basis points on a 10-year, up 6 basis points on twos. From New York, this is Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Regional sports networks,
There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
You've got very sort of mixed signals coming from markets, active risks in various parts of the world, including the Middle East. You know, these are all risks that investors have got to take on board right now.
This is both a international and domestic story, but also very much a DC in-market story.
The 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward.
All this talk about rate cuts, and we remember the market does not care. The market has been concerned with earnings.
Ultimately, when the dust settles on 2024, we will still be talking about a situation where the U.S. economy is growing.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Big 60 Minutes coming up, live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. 8:30 Eastern Time, 30 minutes away, U.S. retail sales, then an exclusive conversation with the New York Fed President, John Williams, sitting down with Bloomberg's Mike McKee. Bramo, as we look at an aggressive repricing of Fed expectations over the last week.
And we've heard a little bit of pushback from Fed officials that maybe there have to be 2 rate cuts rather than 3, that they have the patience to wait a long time. Key question for me is, how does oil change that parameter? How much does they get sort of, does their hand get forced by the fact that commodity prices are rallying for some of the right reasons and some for the very wrong reasons?
Pulling back this morning, let's get to the commodities board. Very briefly, Brent crude is negative by 0.9%, down by almost 1 full percentage point on WTI. WTI 84.86, Anne-Marie, Brent crude 89.64.
And we've been talking about this all morning, this idea of containment of what the escalation could have been. Brent McGurk talking to David Ignatius over the weekend. It was a worst case scenario in what Iran launched, but a best case in terms of outcome. And that's why you're seeing some of those drivers into the oil market starting to take a little bit of an edge off.
I love talking to people about how you price geopolitical risk, because they look at you like, well, what am I supposed to tell you? I don't have an 8 ball. I can't tell you what's going to happen. And every time I try to hedge, I get my face ripped off. So what am I going to do? But of course, you have to keep watching it. And that's kind of how I view today's reaction in markets. It's not exactly like things are cooling off to a dramatic degree, but people can kind of take a sigh of relief and not make it their front page. That's essentially what markets seem to be saying for now.
Working out what the haven is on any given day is increasingly very difficult as well. I know this is a story that you're on top of. Typically, the preferred haven is defined by the nature of the dominant risk. But the problem is the nature of the dominant risk seems to change from day to day. And the way bonds behave, so say on Wednesday, they were the epicenter of the risk aversion, so treasuries sell off, everything else struggles. Friday, they actually received some demand off the back of risk aversion going into the weekend, which could have driven crude prices higher. So work that out for me, please.
Sure, happy to. I can't. Basically, people are taking a look at treasuries and saying, at what price do they act as a haven? And what we heard from Andrew Balls is maybe at 4.6% on a 10-year, they're starting to look more attractive. But if you listen to Peter Scheer, it's the commodity sector that's going to offset some of the concerns about inflation inflation, and that's going to be the haven bid. Ultimately, the haven of yore is not the haven of now, and that, I think, is what this market is telling you.
And the haven of now, at least over the last month, apparently has been gold, because gold keeps setting new all-time highs week after week. I want to check in on the banks just briefly. Goldman Sachs in the pre-market is positive here by 3.66%. About 30 minutes ago, we just had beats across the board: advisory, investment banking, sales and trading revenue. And there is a positive read-through here, Lisa, for Morgan Stanley reporting earnings tomorrow morning. That stock is up by 1.35%.
You mentioned this before, and I keep just focusing on it because it's such a massive beat. The fixed income currencies and commodities trading and sales coming in at $4.3 billion versus the expectation for $3.6 billion. This is a tremendous beat at a time when a lot of people are seeing a revival of the banking industry, a revival of the trading industry, especially with balance sheet put behind that. Here's the question: how much of a read-through does this have to the rest of the complex, or are they just taking Credit Suisse's book? Are they just taking share from other places and taking share back from some of the private asset managers that are now facing higher costs to raise money?
Pretty incredible execution from David Solomon's Goldman Sachs this morning. Coming up through the hour, let's set up the next 60 minutes for you. We'll catch up with National Security Council Coordinator John Kirby on Iran's attack on Israel. We'll speak to New York Fed President John Williams as markets price out Fed cuts. And PGIM's Tom Porcelli responding to U.S. retail sales due in about 25 minutes' time. We begin with our top story: U.S. retail sales data 30 minutes away. Cameron Dawson of New Edge Wealth saying this on the recent information: CPI and PPI and the sharp move in bonds highlight the reality that the Fed and the bond market mistakenly called the all clear on inflation back in the fourth quarter of 2023 and made the assumption that policy was tight enough to justify cuts. The Fed cannot cut as much as they might like. Cameron's with us around a table here in New York. Cameron, are we deciding that they are insufficiently restrictive after telling us repeatedly for the last 12 months they are sufficiently restrictive?
The empirical evidence would support that they are not that restrictive based on the backdrop of the aggregate balance sheets of this economy, meaning because you've termed out so much debt, the diffusion of Fed policy simply has not been as sharp as it has been in the past, which is why that the entire time the Fed has technically been restrictive with the real rate positive, the U.S. economy has grown above trend.
Are we at risk of a 2022 market with all of that in mind? This big adjustment in the bond market, how much of a threat is it to U.S. equities?
2022 wasn't just about rising yields, it was about falling growth expectations. 2022 was the fact that the economy and the market thought that if the Fed raises rates, growth is going to plummet. The problem is, or the good thing is that it didn't plummet. And so the bull market of 23 and into 24 has been about rising growth expectations. So the question is, if the Fed stays higher for longer, do we have to start cutting GDP forecasts for 24 into 25? That would be the thing that could move this market into risk off. Without that, then the risk on can continue.
This raises the question about the discussion we were having earlier, which is, are bonds the same kind of haven that they have been in the past? If you believe that this Fed is committed to getting down to 2%, if they do hold higher for longer, presumably you will see some sort of bid into the long end with expectation for slowing growth.
And it speaks to a haven against what kind of risk? Because the risks that we've been dealing with over the last decade, or really 2 decades, have been deflationary in nature, credit crisis in nature. However, 2022 was the sharp awakening to the fact that if it is an inflationary issue, bonds aren't that kind of safe haven trade, which is why we think that if you're going to want to put safe havens in portfolios, it's not just bonds now, it's also commodities, it's energy stocks, in order to have some protection against an inflationary kind of shock.
Can you give us a sense of how much you've shifted that haven bucket away from treasuries to, say, gold, to maybe Bitcoin or not, to potentially other commodities?
We haven't materially. What we find is that over the very long term, when you are looking at commodities, we keep a 5% or so allocation because they are so mean reverting and they don't necessarily trend. Of course, you've had commodity super cycles. What we have been doing is, now that we've seen this back up higher in yields, we are having the conversations of, let's get ready to buy. Once we get to that 4.75, 5% range, you'd have to see another huge uptick in yields in order to offset the base income that you're receiving, which just means that you want to be buying into weakness, not necessarily selling into it.
This has been a really difficult market. High yields haven't hurt gold. Gold's climbed with yields, 1. 2, high yields didn't hurt tech. Tech outperformed last week and small caps got absolutely hammered. The big rotation that everyone was positioning for in the equity market just came undone last week in the face of high yields and higher for longer. Wasn't that the recipe for them to do well, for the banks to do well? And the banks were down about 5% last week.
It's all about the balance sheets. Big tech has great balance sheets with a lot of cash and very little debt. So if you're having a higher for longer environment, you keep raking in all that high interest rates on your cash and you're not seeing your interest costs go up. The small caps are the opposite story. They don't have nearly as much cash, they have floating rate debt, higher for longer is bad for them. So we think that the real driver of upside is about the balance sheet, and the Fed backdrop for those balance sheets means that higher for longer is bad for low quality balance sheets.
So when does the rotation actually take place in earnest?
I think that the true rotation happens at the beginning of an economic and market cycle, meaning that you're seeing these blips of outperformance. They're short-lived, but they can't sustain because we think we are still fundamentally late cycle. Yes, there's parts of the economy that are early cycle. You're seeing parts of manufacturing do better, which is why high-quality cyclical companies can still be part of the rotation. However, those lower quality names typically only do best early cycle when the Fed is flooding the market with liquidity.
So if I think of the big tech space in particular, I'm struck by the fact that we got news overnight about Apple's shipments coming in much lower than people previously expected. It's some of the lowest levels since the height of some of the supply chain disruptions in 2022. Tesla's reportedly laying off 10% of its workforce, in part because of weak sales in China. At what point does this tech trade get really challenged and it's not just viewed as a couple of idiosyncratic laggards left behind?
That's such an important point because the customers of big tech companies are the rest of the economy. They can only live on an island for so very long, meaning that Meta is 98% advertising. So if you see small business issues, what happens to the trajectory of that sales growth? We have to think about Amazon still being a cyclical consumer company. So I think your point of that you can't have tech be the only thing that does well if you're starting to see economic weakness in other places. But when you think of the names like Apple, I think it's good to remember, it only has 7-8% earnings growth this year and next year, trading at 25 times earnings. That's not nearly as magnificent as what you're getting from Meta, Amazon, Google, and the like.
Okay, meanwhile, we're talking about the potential for a sell-off that everyone's been looking for and that everyone plans to buy. Lori Calvasino overnight was writing about how geopolitical concerns are spiking at a time when stocks already seem due for a pullback. Do you buy into this idea, or do you just think that there is enough cash and enough people who are waiting to get in that it really can't happen, that you can't really get too bearish?
I think that if you were to see a slight shift in narrative, and there's a narrative for every price move, that you might see people put their hands up and stand back a little bit to see what's going on. I think we have seen a deterioration in momentum over the last month or so. You have seen breadth weaken a little bit, but you're not at the point where markets are oversold, which just means that we could still be in this churning environment, even if it's not truly fundamental. We're not changing estimates, but you're just shifting positioning around.
We're about 19 minutes away from retail sales at a time where the data has really made an impact on people's perception of inflation and Fed policy. How important is the 830 number? How much are you watching it to sort of get a sense of how durable this inflationary push really is?
I think this number is incredibly important because we have been in this debate as to whether or not we can trust the employment data. And I think the way that we can judge the employment data under the surface is how much consumers can spend. So if retail sales are strong, it means that employment data is likely holding in better than some of the bears are expecting. The ratio we would watch really closely is the equal weight discretionary versus staple stocks. If that breaks down, it tells you that there could be trouble within the consumer. If it holds up, it means the consumer is just fine, and that means it supports GDP estimates as well, given that's 70% of GDP.
Hey, Cameron, this was great. It's good to see you. Thank you. Cameron Dawson there of New Edge Wealth, head of retail sales, 18 minutes away, and a must-watch conversation with the New York Fed President John Williams and Bloomberg's Mike McKee. Let's give an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Tesla is set to cut more than 10% of its global workforce. The car maker is grappling with a slowdown in EV demand. Those cuts would amount to more than 14,000 employees. Elon Musk, in a letter to employees, cited a duplication of roles and job functions in certain areas. Oil prices are easing after Iran's attack on Israel. Investors, for the most part, betting that the conflict will remain contained, and Axios reporting that the White House would not support an Israeli response. Rapidan's Bob McNally weighed in on the Bloomberg Brief, saying that markets are underpricing escalation risk.
I think it is still. At Rapidan, we actually increased our odds of a material disruption from Arabian Gulf oil and gas flows from 30 to 40%.
And you can watch The Brief every morning at 5 a.m. Eastern. Scottie Scheffler has claimed his second green jacket in only his 5th start at Augusta. He's the 4th youngest golfer to win multiple Masters. Scheffler won by 4 strokes with a 4 under 68 in the final round. Tiger Woods' score was his worst ever. And that's your Bloomberg Brief, John.
I think the fact that Tiger made the cut was pretty phenomenal, given he's hardly played over the last 12, 18 months. Danny, thank you. Up next on the program, Iran's unprecedented attack on Israel.
It's a new Middle East. It's a Middle East in which Israel every day must wonder if some action might provoke an Iranian missile attack or drone attack on Israel's territory direct.
The latest on that story, we'll catch up with Bloomberg's Nick Wadhams down in Washington, D.C., and from the White House, John Kirby, the National Security Council coordinator. All of that coming up next.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Equities on the S&P 500 positive here by 0.6%. Just a brief bounce, a little one, following last week's losses. Going into US retail sales 14 minutes away. The cash opened 60 minutes after that. Yields higher by 6 basis points on a 10-year, 458, and crude lower by almost 0.9% at 84.92. Under surveillance this morning, Iran's unprecedented attack on Israel.
It's a new Middle East. It's a Middle East in which Israel every day must wonder if some action might provoke an Iranian missile attack or drone attack on Israel's territory direct. And it also is a new Middle East in which Israel is now, in theory, open to do the same against Iran by allowing Iran to conduct an unprecedented attack, which was certainly not just symbolic. You now have this new world.
Here's the latest this morning. President Biden and G7 leaders urging calm after Iran's first ever direct attack on Israel. According to reports, Biden speaking to Israeli Prime Minister Netanyahu over the weekend saying, take the win and slow things down. Reports also saying Biden told Netanyahu that the US will not support a counterattack against Iran. Bloomberg's Nick Wadhams joins us now for more. Nick, what don't we know based on the attacks over the weekend that you'd like to know right now?
Well, the big question for me is twofold. One is obviously what will the Israeli response be? The messaging we're hearing from the region is that revenge is a dish best served cold, suggesting that they may wait some time to respond, though it does seem like a response at this point is a certainty. The other question for me is what leverage does President Biden actually have to shape outcomes here? As you mentioned, the U.S. has been very clear. It thinks Israel should take the win and not respond, but there's going to be a lot of pressure being put on Prime Minister Benjamin Netanyahu. On the other hand, he said he's determined to go ahead. So we're really going to see the limits of U.S. influence on Israel in the weeks ahead.
Does this mean, Nick, that there's no longer a red line? Have they just completely evaporated?
Well, that's a great question. Another thing we're trying to figure out. I mean, obviously, this does change the equation significantly when you have Iran launching a direct attack on Israel. I mean, the issue is that this proxy war has been going on for so long. Israel has taken pretty aggressive strikes against Iranian officials and taken out Iranian nuclear scientists on Iranian territory before. So there's a lot that's happened that seems pretty explicit, but just has never been acknowledged. Now that this is just so blatant and so out in the open, you would think that in some ways Israel, or at least they're saying they may feel compelled or provoked to respond. But certainly we're in a moment where it feels like all the bets are off. All the sort of guidelines and rules of the road, such as they are in a conflict like this, have now been shed and put aside.
Nick, we'll do our best to get you some answers. Nick Wadham there of Bloomberg down in Washington, D.C. Joining us now is the National Security Council Coordinator, John Kirby. Admiral Kirby, fantastic to catch up with you, sir. Busy weekend, I'm sure, for you and the administration. Let's get straight into it. We've heard from Iran, at least they've indicated the matter can be deemed concluded. I think we all want to know, Admiral Kirby, whether Israel has indicated the same thing.
Well, I won't speak for the Israelis. I think you can understand that. I believe the War Cabinet is still deliberating and making their decisions. The President had a very good conversation with the Prime Minister right after or towards the end of the attacks on Saturday night. And the President was very direct that this was a huge success, that Israel can be proud that it doesn't stand alone and that it has superior military capability. Iran utterly failed in what they were trying to achieve, and that success alone sends a strong message to Iran and to the region about Israel's place there.
Sir, could we just define success? How can we define the weekend's events as a success, to see the first direct strikes coming from Iranian soil on Israel? How is that a success in any way, shape or form?
Yeah, let's talk about what didn't happen. Hardly any damage, and the only impacts were to an air base in central Israel. No real casualties except, sadly, a young civilian girl was critically injured. And the vast majority, as the IDF have said, 99% of what Iran threw up in the air, drones and missiles, never landed. Either failed or actually got shot down. So that's what didn't happen. And what did happen was Israel proved it has superior military capability, and just as critically, they don't stand alone, that the United States stands with them. I think people are maybe not cognizant of the fact that the President put U.S. forces in harm's way to help defend Israel. For the first time, American fighter pilots in the air shooting things down that were heading towards Israel. And they were extraordinarily successful in doing so. I think that's significant.
You're talking about a successful defense. I think a lot of people also focused on the unsuccessful deterrence. The President said don't, and they did. And we're trying to work out, Admiral Kirby, in what way the U.S. is able to influence Iranian behavior.
Well, the President pre-positioned military forces in the region, which allowed for that unprecedented successful defense. The President met with the G7 leaders yesterday to talk about a unified diplomatic response and to consider other options and alternatives to try to hold Iran accountable for what it did on Saturday night. Iran is increasingly isolated in the world, certainly in the region, and Israel has proven that it has friends.
If Israel does not respond, is the new status quo that Iran can strike Israel from its own soil and there won't be a retaliation?
Again, I can't speak to that, Anne-Marie. That's going to be up to the Prime Minister and the War Cabinet to make those decisions. We respect that, that it's a sovereign nation and they have to make those decisions.
There's lots of reporting that the Biden administration that was verbalizing to the Israelis that they do not support a counter-strike. Isn't that, in a sense, taking one of those tools out of the toolbox and brandishing it to the world?
The tools that we took out of the toolbox were pretty significant on Saturday night, Anne-Marie. Ballistic missile destroyers in the Eastern Med helping shoot down ballistic missiles, fighter aircraft in the air, other partners participating. There was a lot of tools in the toolbox, and that there's no question that Iran recognizes the coalition that was put together to help Israel defend itself. Again, I can't speak for what either side will do going forward. All I can do is speak for President Biden as Commander-in-Chief. He has since October 7th, and he will continue going forward, making sure that we are meeting our commitments to Israel, but just as critically that we're meeting our commitments to our own national security interests in the region, making sure we have the resources in place to protect our troops, our facilities, and the missions that we're conducting there in the Middle East.
We've had 60 tons of arsenal fired upon Israel directly from Iran. We've had 6 months of Iranian-backed Houthis hitting as well, trying to hit even U.S. vessels in the Red Sea and disrupting global trade. We also had an uptick of uranium enrichment by Iran. So to get to this deterrence, what is the U.S. willing to do? We have sanctions in place. Is the United States willing to enforce them?
We have been enforcing sanctions. I mean, my goodness, in the 3.5 years of this administration, we have implemented more than 50 sanction regimes targeting more than 500 entities and individuals. And again, I won't preview coming sanctions or anything like that, but I can tell you that additional sanctions are certainly not off the table in terms of holding Iran accountable. And take a look at the additional military resources that President Biden has added to the region, even before October 7th. This is something that he's been keenly focused on. And as we saw from Saturday night, Iran is increasingly isolated on the world stage. They are increasingly making it harder for anybody in the international community to be sympathetic to any of their inimical interests there. So, again, I think we've done a lot. We'll continue to look at our options going forward, and I suspect that we'll continue to hold Iran properly accountable.
Admiral Kirby, how are they isolated? They had a call with the Saudis. They're sending all their oil to China. They're sending Shahad drones to Russia. In March, Iranian oil output hit a 5-year high. Where is the enforcement?
There is enforcement of the sanctions, Anne-Marie. Again, this is one of the most heavily sanctioned countries in the world. And we're going to continue to look at our options going forward to hold them properly accountable. The sanctions are certainly not off the table. Neither is going to making sure that we've got the capabilities in the region, and we do, to thwart some of their destabilizing activity. You talked about the uranium enrichment. When the previous administration pulled out of the Iran deal, it vastly accelerated the degree to which Iran could start to spin up their centrifuges and get closer to some sort of breakout capability. The president obviously tried. We tried, but Iran was not negotiating in good faith to get back into that Iran deal. But he also made clear that we will not allow Iran to achieve a nuclear weapons capability. We prefer to do that through diplomacy, but if not, we've got other options available to us.
What's diplomacy? Bob Malley, the Iranian envoy, is still under investigation. Who is leading these diplomatic efforts?
As I said, the diplomatic efforts to get them back into the Iran deal are no longer being pursued because Iran wasn't negotiating in good faith, which is why we're going to make sure we have other options available to us to prevent them from achieving a nuclear weapons capability.
Admiral, one question, and Anne-Marie did touch on this question around what the response could be to Iran seizing a vessel in the Straits of Hormuz, the idea of freedom of the seas. What's the U.S.'s response to that, given the fact that a lot of companies have already started to rejigger some of their trade routes and bake in extra costs as a result?
Yeah, I had a little trouble hearing you over the lawnmower there, but I think I got the gist of the question. We certainly condemn this most recent maritime attack. This is a tactic that the Iranians have used in the past. We have, when able, been able to interdict, been able to try to thwart other such maritime attacks, not all of them, of course, and we are also making a concerted effort over time, and we have been somewhat successful in intercepting goods that the Iranians have been trying to ship by sea to some of their proxies in Iraq and Syria, and certainly the Houthis.
Admiral, one thing that a lot of companies are saying, and a lot of executives, is that they do have to make contingency plans because they aren't sure that there can be such safety, and you've seen insurance costs go up. Is it appropriate for the U.S., for Israel, to more directly respond to Iran at some point, just not now?
Again, I can't speculate about future operations one way or another, or future decisions that we might have to make. The president has been clear We're going to hold Iran accountable for their destabilizing activities. He's also been clear that we don't want a war with Iran. We're not looking for another war in the Middle East or to see the conflict that's currently underway in Gaza broadened or deepened across the region. Now, we'll have to see how things unfold over the next coming days here. But we don't want a war with Iran, and everything the president has been doing since the 7th of October has been designed to try to bring the tensions down and to make sure that the United States is best postured to defend our interests there in the region.
You're in a fight now with a lawnmower, sir, so we're going to let you go. National Security Council Communications Advisor John Kirby. John, thank you, sir. Admiral Kirby, we appreciate your time. Far too disruptive for John to even hear us at this point, at the end of that conversation. But some serious points. How they defined success over the weekend. I think there will be a camp that won't define that as success. If you view success as successful defense, success. Limited damage, no casualties. If you define success through deterrence, it's very, very difficult to do that based on how this has escalated over the last few months.
There has not been deterrence when it comes not just to what happened in terms of the more than 300 missiles and drones fired from Israeli soil, Iranian soil to Israel, but also what's been going on in the Red Sea for the past 6 months. Wall Street Journal editorial board this morning says White House theories of escalation management don't work against a regime that thinks a U.S. president fears escalation more than Iran does. How many times have you heard Admiral Kirby say, we do not want war, we do not want escalation? Some say you have to actually put that on the table to not get that war.
I think as Norman Rule said, the former senior U.S. intelligence official, a little bit early this morning as we started this program, whatever you think about the weekend's events, we have a new Middle East. If you are just joining us, welcome to the program. Equity futures on the S&P 500 positive by 0.6%. The scores look like this. Going into U.S. retail sales, a little bit of a bounce here in the equity market. We're up by 0.7% on the NASDAQ 100, following the biggest one-week loss on the S&P going back to late October. Late October is when this equity market rally, this big move higher, started. In the bond market, yields higher through last week by double digits. The 2-year breaching briefly 5%. This morning, up by 6 basis points, 495.46 on a 10-year at the moment, up 6 basis points to 458.30. And just to round things out for you, if we can check in on foreign exchange going into this print on US retail sales, the euro at the moment 106.46. Here's the data for you. So far so good. It's an upside surprise. Retail sales advanced month-on-month read coming in at 0.7%. The estimate was 0.4. You strip out autos and gas, we come at 1%. The estimate was 0.3, and if you're looking for the retail sales control group, the input into US GDP, that is a big upside surprise as well at 1.1% against an estimate of 0.4. The price action off the back of it looks a little something like this, just about holding on to the gains in the equity market of 0.5% on the S&P 500. But in the bond market, we're shooting higher again on a 2-year higher by 9 basis points, just below 5 percentage points, just below 5% at 4.99. On a 10-year up by 9 basis points, taking out 460 all over again, 461.58. Lisa, that is a hotter than expected U.S. retail sales report.
And the revisions from the prior month are all upside revisions. So if you're looking for some sort of dampening effect, you don't get it. It goes to what Cameron Dawson is saying, which is if you see a strong retail sales number, that really confirms the strong employment numbers that we're getting because it's not an anomaly. People have jobs. They're spending regardless of some of the inflation.
Retail sales coming in hotter than expected. Yields are up and equities are just about holding on. The 2-year at 4.99, the 10-year at 4.62. Joining us now, I'm pleased to say, is Bloomberg's Michael McKee sitting down for an exclusive conversation with the New York Fed President, John Williams. Mike McKee, it's over to you.
Good morning, everybody, and we'd like to thank John Williams for joining us on Bloomberg Radio and Television Worldwide. John, numbers just came out. Pretty amazing. Are you continually surprised by the American consumer?
Well, first of all, welcome to the New York Fed. We're celebrating the 100th anniversary of this building here on Liberty Street. So, yeah, the consumer spending has been strong. I think it is driven by strong fundamentals. Job growth has been solid. We've seen real wage gains. We're in a pretty strong economy with good growth. So, yes, it's part of that story. But, you know, I think what we're realizing is we're getting a nice tailwind from the supply side of the economy. Good labor force growth, strong productivity, good real wage gains. So with that, I think, you know, consumers are spending.
What's the thinking in your office and among your colleagues about, does this last? Or is this a surprise that you think could go away at any minute?
Well, one thing that makes it really hard to forecast is we're still feeling the effects of the after effects of the pandemic and Russia's war in Ukraine and all the things that have happened in between. So we're definitely still seeing an adjustment process by the consumer, in the economy overall. But overall, I think that the economy will continue to grow at a solid rate this year. Probably not as high as the 3.1% we saw last year, but something like 2% or around that. So I feel like we're still in a good place. Probably not as rapid a growth as we saw last year.
Speaking of international events, I have to ask you, the Middle East going on right now, how do you think about the economic and policy implications of these events?
Right, so obviously we're watching this very carefully. I think the primary way you see it through is, first of all, through commodity prices, but second is what we think of as a flight to safety, where investors, when they see risks in the global economy, they tend to bring money to the U.S. dollar, and that tends to push yields down somewhat. Right now, I think markets are pretty stable. We're not seeing big movements in that way, but generally that's the way what I would expect to see when you see heightened geopolitical tensions.
When you think about what the markets are reacting to and what could come out of this, is this more of an inflation worry or a growth concern?
Well, it's really hard to say. It really depends on how the situation evolves. Right now, I don't think of this as, maybe in the near term, it could be effect of financial conditions and commodity prices, as I mentioned. I don't see this as a major driver of the overall forecast or outlook for economic growth or for inflation.
Speaking of inflation, CPI came in much hotter than expected and sort of freaked everybody out on Wall Street. And markets sort of took that as a turning point in Fed policy. Do you see it that way?
I don't see it as a turning point. I think that, we saw inflation come down maybe quicker than we expected last year. We definitely saw really lower readings in inflation in the final 6 months. That I never thought that was going to stay that low. That was kind of unusually low. We're now seeing some a little bit unusually high readings. Overall, I think the picture is one of the economy is getting in better balance. We still have a strong labor market, and we're seeing inflation gradually come down. Now, I do think that, for me, what do I see in the data? Well, the economy, and then you pointed out the, retail sales today, but more broadly, the economy continues to be strong. Again, I think we're being helped by strong demand and supply, and those are helping, growth. And we're seeing, inflation come down a little bit slower than expected. And so, I think markets are taking all that information into account and how they expect policy to be. For me, I'm data dependent as always. Really take the totality of the data and think about what it means for achieving our maximum employment and price stability goals. So I don't see this as a game changer or anything. I do think it's important information that will clearly affect my thinking and my forecasts.
Even those who've thought about what PCE might be after the PPI and CPI say inflation isn't coming down rapidly anymore. But you do have the strong growth, you have very low unemployment. Why cut rates if the economy is doing fine at this level?
Well, first of all, I think monetary policy is working at the rates that we have now. So I think monetary policy is in a good place. Over the past 12 to 18 months, we've seen pretty much all the measures of imbalances in the labor market and our economy recede, many of them back to levels we saw in 2018 or 2019. So we're seeing restoring balance in the economy. We are seeing a slow decline in inflation. So I do think monetary policy right now is in a good place. I'm not fixated on where do rates need to go, over the next year. What I'm focused on is how do we best achieve our maximum employment and price stability goals. The data we're seeing show that the economy is strong, and that's really good news, and labor market strong. At the same time, we are getting better balance, and we're seeing some decline overall in inflation. So for me, it's really about getting that right, and then whatever we need to do to adjust monetary policy, we can do to best continue the progress towards our goals. So that's how I'm thinking about it, and we'll just have to keep watching the data and make the decisions based on those goals.
Well, is your base case that you will cut rates this year?
My own view is I think that with inflation continuing to gradually come down, and I guess I would say gradually is the operative word here, and with the economy remaining strong, I do think that given where the level of rates are, real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
So it's possible you don't do anything this year.
Well, again, you're asking me to speculate on what will happen over the next 8 months. Of course. And right now, I think monetary policy is in a good place. We're seeing the progress. We're seeing progress. It's a bumpy road on the inflation front, and we'll just have to figure out how to best adjust policy as needed to achieve our goals.
Well, you mentioned the real rate. Is policy tight now?
I do think we have restrictive monetary policy. I do think policy is tight. So what do I look for? Because the economy is growing. It grew over 3%. We're adding about 275,000 jobs over the first 3 months. So that seems like an economy that's really strong and not being held back by monetary policy. But if you take a step back, all these measures of imbalances in the labor market, whether job openings or wage rates or quits rates or all the other indicators we look at, all of them are moving from being very tight to less tight, and most of them back to more strong labor market or getting closer there. I mean, job openings are still high, wage growth is still a bit high, but these are all moving in the right direction. So I think the stance of monetary policy has really been an important driver of restoring balance to the economy and helping bring inflation to 2%, towards 2%.
What's left with inflation? Is it something that you can affect, or are these non-interest rate responsive sectors?
Monetary policy can affect inflation and the economy. It works through multiple channels. So there are some sectors that maybe are not as interest sensitive, but the economy is interest rate sensitive. We've seen that over the past couple of years as we've moved from a accommodative policy to a restrictive policy. So monetary policy is working. I expect it to continue to work to bring inflation down. You're going to see it show up in different parts of the inflation rates, goods versus services and things. But over the past year and a half, we have seen a broad-based decline in inflation in all these categories. It's just that we haven't gotten all the way to 2%, and we just need to keep policy in the right place to achieve that 2% goal.
Question I always ask is, what are CEOs, companies telling you these days about their hiring plans, about what they're having to pay, and about inflation, whether they're raising prices or having to pay higher prices?
Well, clearly, if you asked me this question a year or two ago, that's all they would be talking about. Price increases, compensation increases, the challenges of hiring employees. Today, I think those comments are still out there a little bit, but far less than before. We're hearing from our contacts, that it's easier to fill positions than it used to be. Wage compensation pressures are less, and price pressures are less. I think that's consistent with what we're seeing overall in the data.
You're the potential growth guy. Has potential growth moved up?
I am getting more optimistic about potential growth in the economy, I think for a couple of reasons. One is, through the pandemic and everything that happened after that, I, like most people, had concerns that the supply side of the economy had suffered, damage, the labor force in terms of labor force and participation. And as we've watched the data over the past 2 years, we've seen a increase in labor force participation, increase in labor force growth, and we've seen a rebound in productivity. Now, I'm not saying that we're in some a new high growth kind of world, but I do think a potential growth is probably closer to 2% or a little higher, which is well above a lot of estimates of the past few years. And that's a very positive sign for U.S. real incomes and for the economy, and honestly, for helping get inflation down.
A question for all of our friends around us on trading desks. You had a briefing on QT at the last meeting from the Fed staff, and members, according to the minutes, generally agreed that it should start soon. Does that mean May, or does that mean June?
Well, I think we said fairly soon, and I think that the reasoning for slowing the pace of reduction of our balance sheet makes makes a lot of sense. It's a prudent course of action. We are decreasing the balance sheet quite rapidly, and by slowing that, we'll have more ability to monitor, assess, and analyze as we get eventually to an ample reserves kind of world that we're aiming for. Everything is going with the balance sheet. Everything is going exactly as planned. Things are going well. When we decide to, slow the pace of the balance sheet, that's a decision for the committee. No decision was made at the last meeting, but obviously we'll get together relatively soon and discuss this further. But to me, this is a sign of success of the plans we laid out almost 2 years ago to reduce the balance sheet. We've had very little disruption in markets. It's worked exactly as planned, and we're just executing on that plan, and that's going very smoothly.
So QT could come before rate moves.
Yeah, these are really separate issues. I mean, on our shrinking the balance sheet, we're focused on getting to ample reserves. On monetary policy, we're very focused on achieving our maximum employment and price stability goals. Those are different objectives. Those instruments can obviously move at different times in different ways.
John Williams, thank you very much, President of the New York Federal Reserve. We'll send it back up to you.
Mike McKee, an absolutely brilliant exchange. Thank you, sir. Appreciate it. Mike McKee sitting with one of the top three on the FOMC following a hot retail sales report. Now, here's the thing with exchanges like that. Sometimes, in an attempt to say nothing, you say something. And that something is this. I think monetary policy is in a good place. I do think monetary policy is tight. That's meaningful, given the fact that we've just had 3 so-called bumps in the road on inflation. And that conversation follows a hot retail sales print in America and a repricing of the bond market again that looks a little something like this. And we can roll through the markets board for you. And we can start with fixed income. Big readjustment in Treasury yields, up 7 basis points to 496. On a 10-year, up 8 basis points to 459.94. Lisa, conversations we've had ever since we got that hot print last week. Are we restrictive enough? Are we sufficiently restrictive? And what you hear from a senior official at the Federal Reserve is they believe monetary policy is still tight, even with this data.
And they are willing to wait and watch the data. The idea of I'm not overly concerned about where rates are going, well, the rest of Wall Street is, and have been trying to game it out pretty extensively. The question is, how much do they start to look at this data and say it prevents them from cutting rates again? He didn't answer that question directly. He hemmed and he hawed and he tried to move around it, but the implication was nothing really has changed. He said that point blank. That data point last week did not change our view, and neither does this retail sales. What will it take then, given the fact that the rest of Wall Street seems to be thinking something shifted?
It'll change things for other people, let me tell you that, particularly maybe at the BOJ. We took out 154 on dollar yen just moments ago following that hot retail sales print. Yields up for the right reasons, I will say. Retail sales coming in hot. Equities holding on. We're up by 0.75% on the S&P 500. The opening bell, 45 minutes away. Coming up very shortly, we'll catch up with Tom Porcelli of PGIM, reacting to an upside surprise for retail sales, and we'll get into those comments with New York Fed President John Williams. All of that coming up next from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in. We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Fairly interesting 20 minutes. Let's get to the market for you. Retail sales coming in hot. Equities look like this, holding on. Positive by 0.75% on the S&P 500, even as bond yields readjust again. Up 8 basis points on a 10-year, staking out 460, up 7 on a 2-year, getting closer and closer again to 5%. In foreign exchange, it means a stronger dollar against the euro, 106.40. Bramo, dollar yen, taking out 154.
Honestly, we were talking about the red line, which was 152, and that quickly got blown up by the idea of hotter prints than usual in the United States. This goes to the question of divergence. How far can other central banks diverge from the Federal Reserve when the currency channel is getting increasingly challenged, and that's what we're seeing in the market today.
Retail sales in America coming in at 1.1%. The estimate positive 0.4. That's the right kind of upside surprise. Under surveillance this morning, the view remains the same. Here's the latest. President John Williams not changing expectations following a hot retail sales print and not changing his view on inflation, eventually coming down. PGIM's Tom Porcelli joins us now for more. Tom, I'd love your thoughts on this. Let's get into these comments from John Williams off the back of that retail sales data, that print just moments ago. Monetary policy's in a good place. Monetary policy's tight. Do you agree?
Yeah, I mean, look, I think it's been really interesting, right? We've had this string of really strong data, yet the Fed doesn't really seem to be changing their tone all that much as it relates to cuts. I mean, some people are pushing cuts out, but they still seem to want to cut. I mean, John Williams literally just said those words. I mean, I sort of cherry-picked one of his comments. He said, so we'll need to start the process at some point of normalizing policy. And my own view is that likely starts this year. I mean, that was his exact quote. You know, I think that this is a Fed that wants to really push ahead. I think it's become incredibly challenging to do it in the very near term. I think we should talk about that. But I think this is a Fed that clearly has a view that they want to cut, and I think they're going to.
Let's get to that comment that you picked up on, though, Tom. I do think it's important. We need to start the process at some point. Says who?
Yeah. So, well, says them, and says they're the way that they view how restrictive policy is. I mean, I think that there's 10 officials who think that they should cut 3 times this year, or at least that was the case before CPI, and they're clearly sort of arriving at the conclusion because they think monetary policy is rather restrictive. Now, look, our own view is that if you look at their long-run estimate, we think the long-run estimate is way low. We think it's actually going to come up pretty meaningfully. And in fact, we would argue that it probably should have come up pretty meaningfully already. But I think, you have folks like, President Williams who believe that policy is restrictive enough for them to really want to start the process of cutting.
What struck me was he also said, I'm not overly concerned about where rates are going. This kind of speaks to the terminal rate, kind of where we're going to end out. It's sort of unique that the Fed is not worried about that. Everyone else is. Why is it important to worry about that?
Yeah, I mean, look, because it goes to exactly this idea that we were just talking about. It's how restrictive are you going to be? And I think you could easily make the argument that, if you look at sort of nominal long-run rates, they probably should be closer to 3.5%, not closer to 2.5% that the Fed is pinning in their SEP. And so I think it's sort of nice to say we're not really so worried about what's going to happen down the road, but the market is. I mean, 10-year yields at the end of the day are supposed to be a reflection of what you think Fed funds will average over 10 years. And so the market is trying to figure that out. And this is an idea that, Lisa, you and I have talked about over the months. It's like the market is still very much in price discovery mode. I mean, I look at 10-year yields at 4.6% right now. And the move that we've seen over the course of the last week or so, the market is trying to gauge where this is going to shake out. Again, I would argue that, if you wanted to put a pin in a number, 450 probably seems about right on 10s. Again, you have to draw a circle around that, but I mean, just as a starting point for the conversation. And I think that, to me, is a really instructive way of framing President Williams' comments.
One thing he also said is just to take each data point as it comes. And we've seen a number of hot data points. Do you think that this is sort of a flawed process? We've talked about this with Mohamed El-Arian, that the idea of coming without a thesis and just coming from backward-looking data points and trying to push them forward when we're going to revise them later anyway could be problematic. Do you agree?
I do. I think data dependency, the way that we've defined data dependency, which is to say, sort of allowing the market and even Fed officials to shift their views on every single data point. I don't think that's the right way of crafting monetary policy, because I think it lends itself to a lot of volatility. I mean, I think about that CPI report, and again, make no mistake, I get it. The Fed's not cutting in June anymore, but I think it's worth sort of understanding, well, what really did a lot of auto insurance, and the other was healthcare, which I think is sort of well-worn idea at this point. If you're going to be hanging your hat on every singular data point, then I think you do have to go through the process of dissecting every single data point to make sure that the reason it rose is sort of a legitimate reason and something that policy can affect. And I would argue that the reason CPI rose is not something policy can alter.
The other thing that policy can't alter is commodity prices, and we've been grappling with this. How is the Fed going to respond if we get a spike in oil prices, but also just more broadly a structural bid to the commodity sector? Should we be thinking about it, though, in more of a long-term story, just simply because of all the infrastructure spend and all of the different features that are really going to give a bid into the precious metals and beyond?
Yeah, Lisa, I think the way that the Fed will think about that is, the sort of through the classic channel for them. They're going to think about it through the lens of inflation expectations. You get a lift in commodity prices. How does that alter people's perceptions of inflation through the expectations channel? And so if you start to see inflation expectations start to drift, and in fairness, they really haven't, but if you start to see them drift, I think that's what the Fed will wind up responding to in the end.
Hey, Tom, this was great. I just want to finish with one final question. I know you're in a different seat now, but I do want your best guess. We saw some big revisions last week. Mike Gapen, Bank of America, June out to December. Matt Lazzetti now saying December as well. Where are you at now, Tom? Yeah,
look, I think that to get July, I mean, I've become almost bimodal in some way. I mean, I almost feel like you're either getting zero or you're getting a lot of cuts. I think July is going to be very complicated. You have to get this string of really sort of, palatable inflation reports between now and then, and you get 3 between now and the July meeting. So I think July is certainly on the table. But if you don't get July, they're not going in September, and they're not going in November. I know the Fed likes to say, well, hey, look, we've adjusted policy around elections. Yeah, but they've only done that when policy has unquestionably needed an adjustment. If it's a debatable point, they're not going to be able to go. So if you don't go in September and in November, so if you don't go in July, then I think it leaks all the way out to December. So I think at best the Fed gets 1 in this year, maybe 2. But I think the calendar is sort of working against them.
Interesting. Tom, thank you, sir. Tom Porcelli there of PGIM. Heard that a few times in the last week. The last pre-election option on the window, the last window on the calendar is July. And then once you go past July, you start creeping towards December.
Which is the reason why we've seen so many people push back. Who was it, again, who came on this show and basically was talking about December? And we all said, you're crazy, no way.
Stephen Stanley talked about it.
Stephen Stanley, exactly right. And he seems to be on a page that everyone seems to be coming toward. Remember how crazy we thought he was at the time? Not crazy. We didn't think you were crazy, but it was a bold call.
Not crazy like mental, but sort of out there.
Not this kind of crazy.
Not
just sort of,
crazy.
Just sort of general kind of, bold.
Crazy. No, but some interesting calls out there at the moment. I think we're all on the same page for this. At the moment, you look at global growth, front and center, US exceptionalism. We saw that a lot coming into this week. You see it again on the screen looking at retail sales, the US versus the rest of the world. The man who wrote the article on that in the last week is going to join us tomorrow morning. Mohammed Al-Aaron of Queen's College, Cambridge, alongside PGIM CEO David Hunt. Fantastic lineup for you. Whaley of BlackRock, Torsten Slock of Apollo, who said it now for a few months. No rate cuts in 2024. That conversation coming up tomorrow morning. Your opening bell 34 minutes away. Equities looking okay. We're positive 0.75% from New York. This was Bloomberg Surveillance.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly, we want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Farrow. So the equity markets re-galvanize themselves. The consumer is strong, retail sales are mighty, yields pop higher, and they do not challenge this equity market yet. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up in the show, bond yields push higher, as I say, on the hot retail sales number. Futures bouncing higher after Goldman delivers a beat. And oil shrugs off Iran's unprecedented attack on Israel. We begin with a big issue, Iran's attack on Israel.
And we have a shared responsibility to actively engage all parties concerned to prevent further escalation.
This operation is over, and there's no intention to continue the operation. But if the Zionist regime takes any action against the Islamic Republic, our next operation will be much larger.
Whoever strikes us, we will strike him. We will defend ourselves against every threat, and we will do this calmly and with determination.
We will continue to help Israel defend itself.
If the U.S. initiate military operation against Iran, Iran will use its inherent right to respond proportionately.
Let's give you context as it goes 9:01 in New York. Anne-Marie Horder. Anne-Marie, if you look at the language being used by the Brits, by the French, and by the United States of America, are we really at some kind of a hiatus in terms of escalation from Iran to Israel? But Israel to Iran is the next conundrum.
Well, that's what everyone's waiting for. And if you look at some of the reports from over the weekend, the president reportedly told Benjamin Netanyahu to take the win, meaning potentially we don't want to see a counter-retaliation strike from Israel to Iran. What we've learned over the weekend, though, is that red lines have quickly disappeared. There was a red line between Iran sending drones and missiles from their soil directly to Israel. Now, that has completely evaporated. So you do see Iran pushing and testing the waters even more. When you speak to administration officials, and we just spoke to Admiral Kirby, he's deeming this as a success because of the defense posture of the United States, the minimal, very minimal damage that was done. But the issue, of course, is that what does this mean for deterrence? Because Iran was not deterred to take that strike.
No, they were not deterred, and one could say that there's a reactionary American foreign policy response on Iran. When it comes to markets, the oil market has not batted it away, but it has been less frenetic. We're lower this morning than we were a week ago. So at the moment, the markets, the oil markets, are taking this as a win. But the next iteration of this, Anne-Marie, is what happens with the proxies, particularly Hezbollah in Lebanon into Israel. And that is the dynamic that this oil market is perhaps a little bit more concerned about. The proxies in the Red Sea, the proxy in the Strait of Hormuz.
Absolutely, because you wake up this morning and not a single barrel was affected, even though we saw the biggest barrage on Israel coming from Iran directly. Oil supply continues to flow. Nothing was impacted. So that risk that we saw in the price premium on Friday, that's been completely taken out. There's still geopolitical risk, but at the moment, the oil market seems to think the situation is contained.
It is indeed. And the spare capacity, ironically, is held in the Arabian Gulf, the Persian Gulf, indeed. And that is something the market has yet to fully price. Anne-Marie Jourdain, thank you very much. From geopolitics to Goldman Sachs and the big beat. The Wall Street Giant recording 28% jump in net income. That was for the first quarter. Bloomberg's Sonali Basak joins me now to break down the numbers. It's the return of the trader, return of VAR. It's back to basics at Goldman. Sonali.
Back to basics. You can call it a hat trick, Manus, because they are beating on many fronts here. The traders, the investment bankers, advisory revenue alone came in above $1 billion. Fixed income financing also hit a record, as well as equities having its best quarter, second best quarter on record for equities financing, helping traders really beat the mark here. When you look at the equities business alone, not only did it beat JP Morgan in an absolute term, when you look at the revenue, it also brought in more than what is expected out of Morgan Stanley tomorrow. So you see David Solomon returning to the basics over here at Goldman Sachs, a lot less noise around that consumer business that we were talking about this time last year.
And in terms of the cost, one of the things on Friday that really came to mind when we were looking at JP Morgan, and we broke those down on the set live on Friday, is the headcount expanding at JP Morgan, the cost basis expanding at JP Morgan. Now, costs are also rising at Goldman's, but talk us through the reasoning why, because a lot of this comes down to the allocation to the bonus pools through the various quarters, but just run me through the nuance.
To your point here, if you're making more money, you have to pay people more as well. Interestingly, though, Goldman had so much discipline around their headcount early on. They made those headcount cuts way before much of the street even started to. So what you're seeing is, even if you see a swelling of some costs here, their efficiency ratio came in a lot better than expected here over at Goldman Sachs. Now, can that be the same tomorrow for Morgan Stanley? We know industry-wide they're facing rising costs, certainly tied to compensation, but also everything, Manus. Everything is more expensive for the average American. Everything is also much more expensive for the banks.
Indeed, and of course, asset management, wealth management up 18%, not to forget those parts of the bank as well. They'll all be clamoring out the door of David Solomon at bonus time. Sonali, thank you very much. We'll be working on the banks throughout the week together. Let's take a look at the broader banking picture. We're joined by Chris Maher, Chairman and CEO at Ocean First Bank. More based in New Jersey, operating over 100 years on the East Coast. Ocean First will themselves be reporting their earnings this Thursday. Good to have you with me, Chris. So here we are.
Great to be with you.
We have this glorious backdrop for the street with Goldman's today, but I look back to Friday and we were so anxious over the net interest income story at JP Morgan and the other names in the US. Just talk me through the challenge for net interest income. Lay it out why it's such a hot button topic, Chris.
Sure. I think, Manish, you really kind of narrowed in on the real question here between Friday and today. Goldman did what Goldman does best, right? They have the trading revenue, less dependent upon rate scenarios, less dependent on the balance sheet. As we look to the universals who reported last week, really this question about what will the rate environment be, and then depending on the rate environment, what impact will that have on net interest income or net interest margins? And it's really about two things, higher for longer and the shape of the curve. So higher for longer, meaning, as we've all seen, these recent inflation prints are going to cause the Fed to be more cautious. So expect no relief on that regard for quite some time. And then the shape of the curve, right? What happens to the long end versus the short end? I think that's what's going on.
And we've just finished our conversation with Williams, the New York Fed, with Mike McKee, and I think it was really, really evident the desire to keep the dream of cutting rates alive. And that was very clear during that conversation on real rates. They're considerably higher, and policy is tight. They see the opportunity to cut rates this year. Do you think that's just trying to keep the dream alive? But when you look at the inflation narrative, it's a tough one. It's a tough one to sell. And by the way, geopolitics is pushing the inflation risk ever higher again.
Yeah, Matt, I'd look at two things. I'd look at the inflation numbers, but I'd also look at employment. You know, the main reason that you would want to start cuts is that you believe that there's a weakness in the economy that you want to get ahead of. And it's very dangerous to wait until you see the employment numbers change to make that cut, because often that's you've kind of lost your time, your opportunity to do that. But the recent employment numbers have been so strong, the argument for a cut, independent of the inflation report, I think is a big question here. You know, why are you cutting and for whom?
And therein lies the conundrum for the banks and the Friday narrative relative to the Monday narrative. In terms of the translation to the real economy, Chris, what can you tell me? We just had a blowout retail sales numbers. I mean, to quote UBS, it's a brilliant phrase, the hedonism of the U.S. consumer remains. Can you see that? Is that manifest? Is the consumer as strong, or are they playing on a string of credit?
The consumer is strong. I mean, certainly you see a little bit of movement in credit, but the consumer is spending. The consumer has confidence. We're seeing that in things like the retail sales figures. I think there's also an overlay as to what's happening in residential housing. You know, if you can't buy that next house, maybe you've got a little bit more disposable income to go out and do that. But you know, I think one of the narratives here is this. The sector, the banking sector, generally kind of more traditional banks, is priced as though there is a significant credit event on the horizon and a significant kind of rate drag. And I think when you think about both of those things, it's unlikely that they're both true. So a stronger economy, while that pressures rates a little bit, it does mean that the credit outlook should be much stronger for U.S. banks. So as long as the economy stays strong, we've got these employment figures, these retail sales figures, you're just not going to see a credit event of consequence.
Yeah, I think the people that talk about credit events, that talk about sort of material risk events, are probably sort of people that are scarred from GFC and scarred from 2000, dare I say it, scarred from 1994. So perhaps it's generational about who's writing about the events. With all of that in mind, therefore, can you see a scenario where the dividend, the buyback, and the releases, the actual releases from the bank? Because if you look at the credit numbers in JP Morgan, and you look at the credit numbers from Citi on Friday, the credit provisions, they were materially lower. So do those write-backs, dividends, and share buybacks, they actually escalate?
Yeah, I would not be surprised to see credit conditions this year be reasonably favorable. I mean, we're already significantly into the year. We talked about the employment numbers. We talked about the retail spending numbers. So if credit performance is going to be solid, you're going to see increasing pressures on banks over the next couple quarters to really look at those reserves. I think it's a little too early yet to expect people to be releasing reserves until there's a little kind of certainty around the soft landing, which is still up for question. I think all eyes are now turning towards, well, you know, 2024 may be a decent year for credit, but does the Fed wind up having to do something late in 24 or early in 25 that causes a sharper downturn than we would have expected thus far? So, you know, if you can see these kind of credit pressures going into 2025, you're going to be unlikely to release reserves at this point.
Okay, I suppose I'm just a bit too enthusiastic and a bit too bullish. Chris, you can never be too bullish. Chris Meyer there of Ocean First Bank giving us his time this morning. Stocks are moving ahead of the opening bell from tech to banks. Abby's kicking it off with Goldman's. All hail Goldman Sachs up 4%.
Indeed, the stock is sharply higher, certainly helping the sentiment this morning relative to the quarter that they posted. All about those big trading results driving profits up 28% on a year-over-year basis, and the stock higher today. Schwab, though, not so much, down 1.2%. Revenue was better in the first quarter, but new assets disappoint, and that seems to be the way that investors are choosing to interpret the results. Apple off of its lows down about 0.5%, as IDC says that the company shipped about 10% less phones this year in the first quarter than last year, and that's consistent with some of the reports that we've been receiving, certainly around China. And then finally, Tesla down about 0.6%. They're cutting 10% of their global headcount. Elon Musk saying that the duplication of roles and the need to lower costs is behind this. this. This stock down about 43% from its last peak. The question is, will it go lower, or is it going to go back up into the range? The stock year to year seems to go higher, lower, higher, lower.
Yeah, well, you're going to hear that clamor of buy the dip. Abby, thank you very much. We'll catch up through the morning. Treasury yields are spiking with a blowout set of retail sales numbers for March. More on the hedonism of the U.S. consumer as you see 10s up 8 basis points and change on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Real interest rates now are considerably higher than they were before because inflation has come down quite a bit. So we will need to start a process at some point to bring interest rates back to more normal levels. And my own view is that we will, that process will likely start this year. But again, it's going to be driven by the data and achieving our goals.
That was the New York Fed head, John Williams, speaking with Bloomberg. In the past hour, we also got the data out signaling resilience of the U.S. consumer. Joining us now is the man who conducted the interview, Bloomberg's Mike McKee. Mike, good to have you with us. So, I mean, it was an acknowledgement. Policy is tight. We're on a bumpy road. We know that one. But I'm drawn to the policy is tight and indeed considerably higher. And that could be the flag to the market. If you look at this bond market this morning, they've taken the interview, they've taken the move, and they see this as a good sign from Williams.
Well, he did say, Manus, that he expects rate cuts this year, and as you pointed out, he justified that by saying real rates are tight. He thinks the U.S. is getting a tailwind from the supply side. As supply chains normalize, we are seeing lower prices, or lower inflation, rather, and that is keeping Americans able to spend. And spend they did. A huge increase, as you've been pointing out, in retail sales, particularly in the control group that takes out gasoline, takes out automobiles, up 1.1%. And in every category, there were revisions higher to the prior month. So Americans still continuing to spend, and that is something that the Fed is going to be concerned about going forward. I asked him, why do you want to cut rates with the economy the way it is? And basically, he seemed to say, what we're thinking is that this is not the right interest rate for this economy. It could be a little lower because of those those real rates being tight on the economy. But overall, he sees the U.S. economy in a very good place and says the fundamentals look very good. I did ask him about the CPI, of course, and he said that was concerning, but they're keeping an overall eye on inflation and don't think it's out of control yet.
Okay, it's that bumpy road. There's a lot of those in Ireland. Mike, thank you very much. Mike McKee with John Williams this morning at the New York Fed. Let's turn to the credit markets. I'm joined now by Amanda Lynan, BlackRock, head of macro credit research. Before we get into the weeds of credit, Amanda, listening to Williams this morning, it's a tacit acknowledgement by the Fed that rates policy is tight. How do you think the market will interpret this from the New York Fed? Is it to reinforce the narrative of insurance cuts are coming?
Sure, and good morning, Manus. Thank you for having me. So I think the market can see that policy is tight in certain pockets of the economy. So interest-sensitive asset classes like commercial real estate transaction volumes have been really low. Certain parts of credit with floating rate borrowers, we've seen fundamental metrics either be range-bound or slightly deteriorate in some instances. So I think that's probably not new news to the market. I think maybe the market would push back on the sense that policy is tight broadly because, to your point, and as you've been discussing all morning, we've continued to have surprises to the upside, whether that's in the payrolls reports or retail sales or just overall GDP. As it relates to President Williams' comments, I think the key point from my perspective for risk sentiment is this still this posture that, one, we are likely at peak policy rates, and two, cuts are coming at some point in 2024. As we've discussed previously, those are really important for risk sentiment in the credit markets, and so I think it was good to hear that. But at the same time, we've all seen that this is indeed a bumpy path. There's a significant amount of uncertainty. And so I think the real risk that we've been flagging is a sustained reacceleration in inflation. And if that sustained reacceleration in inflation is the reason that we don't get rate cuts in 2024, I think credit spreads would need to move wider to reflect that, just like they've been moving in recent days, I think, after the CPI.
And it's a very important nuance that you remind me of, which is credit is tight in certain pockets of the economy. It's not just one big painting brush, as I am prone to do, and I think as is the market prone to do. Okay, let's just deal with where we are. If you think back to Friday, havens were bid, bonds were bid, all on the back of geopolitics. We move forward. The geopolitical risk is tamed but not vanquished, and I look at bonds up 8 basis points on retail sales, and indeed, Amanda, and this goes to the geopolitical point, if there is an escalation, continued escalation in any way, you're looking at an inflationary escalation. And so the bond market is back to basics. Inflation is hot, up by 8 basis points. So are we going to test, we're going to retest this inflation narrative again in the bond and credit markets?
I think the key point for the geopolitics, which you've been flagging, is that this is just such an unprecedented event that while we were happy to see that there was not a significant amount of damage over the weekend, really, I don't think the market is discounting the risk of a further escalation completely. So that's kind of point number one. Point number two, as it relates to credit, is, again, this reinforces a couple of things. One is, if there is an escalation, there should likely be a repricing of risk premium in credit spreads, just like you would typically see. And then two, it really goes down to this point, if we have inflation because of, say, a commodities disruption or a supply chain disruption, that point on sector and issuer dispersion becomes really important. So on the sector side, are you a commodity producer or are you a commodity purchaser? You will likely have very different outcomes in such an environment if we do have a supply constraint in certain commodities, for example. On the supply chains, is your supply chain resilient, or do you rely on kind of global transport across international waters for your goods to make it to their end destination? Those things will matter more. They matter more in certain environments when geopolitical risks are heightened, and that is something that we are watching in addition to kind of the overall risk premium that could be priced in.
Again, it's about doing the homework in terms of which credits have more exposure to the story and the narrative. I think the number is between $20 and $33 billion worth of investment-grade credit will come down the pike this week, mainly from the financials. The 10-year and 30-year sovereigns took a bit of a jolt last week. I know there was a lot going on. It took a little bit more to get rid of those sovereigns of 10 and 30-year paper. When you see 20 to 30 billion of financials coming down, how do you think the market will take those on the investment grade side?
Sure. I mean, I think in general, the narrative so far this year has been there is a significant demand for new issue paper in the market, largely because in many of these instances, this paper is used for refinancing. So there's not a ton of incremental new money coming to these markets. That's particularly true in the leveraged finance side. I think relative to just a few weeks ago, we've had a third consecutive month of hotter than expected inflation. We've got some heightened geopolitical risks. It would be reasonable to think that the market would need to reprice a little bit to entice folks to come in if we have significant supply coming to the markets. But in general, I think the demand for investors is still there. It's still quite resilient. Again, much of the supply that we've seen in the live fin market in particular has been for debt repayment and refinancing. And so investors will want to stay invested. And I think we've seen that so far this year. It's been pretty robust.
There's a lack of indigestion. It's yet to arrive. Amanda, thank you very much. First reaction to the Williams interview there at BlackRock. Coming up in the show, your morning calls, and later Samir Samana joins me from Wells Fargo, making the case to reduce your risk now. Why it's time to play it safe. That conversation still ahead.
Was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep rating World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Despite yields rising by 8 basis points, these equity markets are flicked around, because for the moment we're talking about trying to get a de-escalation in geopolitical risk. Retail sales were firm, to say the very least. Roll it over and you have a look at what's going on with the bond yields, up by 8 basis points. Again, you are just seeing this narrative of a stronger retail sales, and that is pushing your yields higher. More issuance to come in the bond market. Let's tell you what's going on with the upgrades from the street. First up, JP Morgan upgrading Lockheed Martin to overweight, expecting the shares to benefit from mounting geopolitical tensions. Bank of America upgrades Cisco to a buy, seeing favorable setup with multiple catalysts driving growth. And finally, Citi opens a 90-day positive catalyst watch on NVIDIA, pointing to the recent declines and strengthening demand trends. Coming up, buyer beware. Samir Samana joins me from Wells Fargo, saying it is time to be cautious with your equity market allocation. Why? Why step back now? That conversation next.
think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Of course, they're happy at the NYSE along with the NASDAQ. You've heard it from John Williams. Policy is tight. They're keen to do something. The data will drive it. The consumer is strong. Retail sales are blistering. Stocks are higher this morning. Goldman Sachs is back to basics. FICC is up and roaring. What is not to love about this? Oil is rolling down. Geopolitics, of course, is a critical issue. And for now, the world seems to be trying to call for some kind of a de-escalation. Policy divergence is the narrative. The dollar was the go-to as a haven. We're back to flat on euro-dollar. Yields rise by 9 basis points. Retail sales, excluding cars and gasoline, rise by 1%. The consumer is just no stopping it here. But you're back to inflationary risk in the bond market, and crude is down by 0.7%. Perhaps in many ways because of this de-escalation narrative from the United States, from the Brits, and from the French in terms of their communication with Israel. Let's see how that actually plays out on the Iran strikes on Israel over the weekend. To Goldman Sachs, the bank reports a net revenue for the first quarter that was higher than the analysts expected. That is the understatement of 2024. Shanali Basak shines a light on what went right with good vol, one could say, at Goldman Sachs. Shanali.
Good vol and more money, Manis. You have really Goldman leading on financing here to drive that trading desk higher, really leaning on its traders and investment bankers here. I would also point out that advisory fees alone within the investment banking business topped $1 billion. The call is starting right now with David Solomon going to meet analysts on how much that train can keep running. Remember, today's deals are tomorrow's fees. In the first quarter alone across the M&A landscape, 44% higher. You saw deal volumes run. And in terms of advisory fees, Goldman's were 24% higher already. So that will translate as the year goes on. Now, remember, the second half of the year could bring more volatility with an election cycle. So the sustainability of the performance here over Goldman Sachs will be front and center as executives start to take calls from analysts.
You're killing me, Shanali. Today's deals are tomorrow's fees. There you go. Well, let's see what David Solomon's got to say. From banking to Salesforce, all about your CRM, the company targeting Informatica to boost its data capability in what would be the biggest ever deal. Abigail Doolittle has the details. Abby.
What's really interesting here, Manis, is that we have Salesforce.com, not surprisingly lower, as the potential acquirer. We don't know that this is going to happen. People are saying that it could happen within the next month. But Informatica, the targeted company, one within the software as a service industry, those shares are lower too. You don't always see that. One piece of it could be the fact that when this company company was brought public again back in, I think it was 2021. Shares were at $29. They were as high as $39, and now they're closer to $14 thereabouts. So Salesforce.com, though, really looking to fend off private activist investors. This would be one of its biggest deals. It would certainly be the biggest deal since buying Slack back in July of 2021 for $27.7 billion. Mark Benioff, CEO there, really, again, trying to make a move that would fortify the company to some degree from those private investors. And it's not known if and when this deal will happen, but if it could or does, it could be as soon as by the end of the month, Manus. Interestingly, Informatica over the last year up 149%. That could have something to do with the stock being down. And CRM, Salesforce.com, not so shabby, up about 50% over the last year. So they have some capital to buy potentially Informatica.
Okay, Abby, thank you very much. Keeping the deal flow alive. A lot of investment bankers out there salivating at that. To EVs, Tesla cutting over 10% of the workforce after a slowdown in demand, with Elon Musk preparing the company for the next phase of growth. What does that mean? Ed Ludlow is with me. Ed, this story has brewed since 5 a.m. when I got here. So let's talk about the evolution of that 10% of the workforce. What does that translate to?
10% of the workforce translates to about 14,000 staff worldwide. I've just broken the story, Manus, with the stock down 1.4%, that there is another development. Drew Baglino, who was the senior vice president for powertrain and energy engineering, resigned in the last 24 hours. Drew Baglino has left Tesla, and this is separate from the layoffs. My understanding from a source is that he resigned of his own volition. The timing is interesting. Drew Baglino is not a household name, but he's incredibly important to the history of Tesla. He's one of just 4 stated or listed executive officers, or he was, and has been at the company for more than 17 years, reported directly to Elon. Responsible for everything energy related, the powertrain on the cars through to the energy storage product. That's a really interesting development. We've also reported in the last couple of minutes that Rohan Patel, who is basically the public policy chief at Tesla, has also left the company. Less clear if that was to do with the 10% layoffs or not. What Elon Musk said to the company last night in a memo that sources shared with me is that they had just grown too fast, and in many cases there were duplicate roles. This is a 10% cut. The last cut in 2022 was also 10%. And you and I, when I was in New York, if you remember, talked about the big miss on deliveries in the first quarter. You know, it's a company facing macro headwinds, but the stock down 1.3%. The layoffs part of that story was quite well telegraphed. The rumors started Friday night, but the Baglino piece, quite a big one.
The stock is down 31%. I mean, this is in some ways mutual decisions. We don't, mutual decisions, strategic decisions. Either way, yeah. It's quite an evolution of change in who's going to be running this business, isn't it?
Yeah. There's always been a question about succession with Elon Musk, or how things work. If you read the Walter Isaacson book, or actually Ashley Vance's book on Elon Musk, he was a micromanager. But in more recent times, the company's actually been in quite rude health from a sort of bench of talent perspective. One of the things that I understand from sources about Drew Baglino's decision to leave was actually he felt that the company was in a good place in the areas he was responsible for. 4680 is apparently going quite well. There is a deep bench of talent on the energy side of the business. And as Elon Musk talked about during earnings, the growth in the energy business is expected to outpace the car business this year. But it means that Drew Baglino is not next in line to be the CEO of Tesla if Elon Musk ever decided to step down. So now we can start having conversations about who that future person might be, if at all Elon Musk ever decides that he doesn't want to be the CEO of Tesla.
Okay, great reporting and great work on the scoop there as Ed Ludlow tracking the Tesla flow. Let's turn our attention to tech. Apple's iPhone shipments slide 10% in the quarter to March. The issue? Sales in China. It is the worst slump since the COVID lockdowns of 2022. Alex, good day to you. This is driven in part by the politics of China in terms of who they want to promote domestically, isn't it?
Well, we don't fully know the motivation for what's going on in China from a governmental perspective, but yes, that is one of the things that people have guessed at. That's the interpretation. They have excluded Apple and some other manufacturers from state-owned enterprises as well as government bodies. But this alone is not enough to affect Apple's sales in the country. The broader issue is there's been a real resurgence of patriotism in terms of supporting local brands, the likes of Xiaomi and Huawei. Xiaomi jumping 34% in the quarter. And the really interesting thing as far as Apple is concerned is not only did their sales drop 10%, but the market as a whole grew about 8%. There was an interesting wrinkle, though. This is all, we should say, estimates from IDC, the market research company. The interesting wrinkle from them is saying that the sale of high-end smartphones across the industry was very, very good. And what we've seen from Apple in previous years, previous quarters, is even as unit sales have been slow or in fact declined, they've managed to continue to grow the top line because they have been selling the top-end iPhones, the iPhone Pros, and particularly those with big memory options where there is a very significant gross margin. That can be incredibly lucrative. So never quite write Apple off. The shares obviously a little bit down on this. There was already quite a lot of expectation that China was going to be disappointing. This seems to be confirming that.
Okay, Alex, thank you very much. Great update. Just a quick snapshot of what's going on with Goldman's. We've got a T-Live blog on the run. The stock is up, as you can see, over the past 2 days. So we're peaking out here, up 6% at one juncture pre-market. But the beautiful lines from Solomon as he goes on the call, which is, I've said before that historically depressed levels of activity wouldn't last forever. So this is about where we are in the trajectory of, as Shanali beautifully put it, which is deals today are fees tomorrow. 25th consecutive quarter of long-term fee-based net inflows to wealth management. Significant strength in WM. So the stock is quite literally on a bit of a tear this morning, turning it around on the return on equity story as well. So global markets. They're calming as traders speculate that diplomatic efforts will help prevent the conflict between Iran and Israel from escalating. Is that presumptuous? Is that too early? Let's ask Samir Samana, Senior Global Market Strategist at Wells Fargo Investment Management. These markets, good to see you this morning. These markets were under pressure on Friday. The bond markets were haven bid. Equity markets were under pressure. Do you think it is presumptuous by equity markets, which are emboldened by the retail sales, to presume that geopolitics is in the rearview mirror?
I mean, look, markets have been presumptuous for about 6 months now, right? So whether it was rate cuts, whether it's better earnings growth, whether it's better economic growth, whether it's that geopolitics is in the rearview mirror, I mean, the market's had kind of this positive sentiment where it's kind of looked at the glass as half full. I guess what we would say is we continue to see the risks kind of piling up, the uncertainties, starting to pile up. At some point, you've got to be willing as an investor anyways, if you're clear-eyed, if you're disciplined, to be, able to pay a lower multiple, not a higher multiple for, kind of all these uncertainties. And I guess that's where the opportunity lies, is you can probably take the rally today to trim any positions that maybe you were, regretting you had on Friday.
Yeah, sell the strength. I can take that. This is what you've said most recently, which is that the market knows the chance of a zero rate cut this year is rapidly rising. This as sticky housing, sticky housing inflation, along with higher energy prices, upside stock momentum is curbed for now. So you're a seller into strength on this. Do you think that we have lowered the bar for this earnings season that we're about to go into? I'm seeing notes in my inbox going, oh, we've trimmed back what we're expecting from earnings. But earnings were supposed to plug the no rate cut gap.
Yeah, I would agree with that. I mean, look, it's possible that analysts have revised their expectations lower, but honestly, I'm not sure I find that all that material, right? I mean, that's kind of the dance that happens almost every quarter. What I like to look at is what the equity market did going into earnings season, and we had a pretty good run, right? And I think that's where true expectations lies, right? That's where the expectations of the people buying equities lie. So if you bought equities and they're up over the last 3 or 4 months, you want to get, some evidence that, the reason you committed capital was for the right reasons. And I think the bar, I would say is pretty high. Again, we might come in better than expected, but is it going to be enough to justify the recent gains? We're not sure.
I mean, you're also in the light. Now, I've got various guests that come on and go, let's go for breadth. Buy financials, buy energy. It's broadened out nicely beyond the Mag 7. That's what you should be doing. You believe that I should be trimming some of those outperformers in comms, tech, consumer discretionary, and indeed favor the energy market and materials. Is that an active rotation that clients are engaging in?
We hope so. We've had a really good playbook this year. We've been favoring large caps in the U.S. over international and over smaller caps in the U.S. And I mean, lo and behold, they've done really well for the folks that have been, kind of following that advice. And then if you look at sectors, we like industrials, we like materials, we like energy. All of those sectors have done well. We've paired it with healthcare, which is a little bit of a defensive. I would say because it's lagged, it's probably an opportunity here. And then we've kind of paired it with unfavorables to discretionary, to real estate, and to financials, all of which were very heavily oriented towards rate cuts and towards, again, kind of the Fed bailing out the financials by creating a steeper yield curve. Right now, it looks like their hands are getting tied more and more with every passing day.
There just seems to be, you look at rates market this morning, up 8 basis points, strong retail sales number, the core retail sales strong. Again, there seems to be an indifference by the equity market to a spike in yields. Do you think that we're at some kind of an acceptable balance in equity markets of where rates are, in excess of 4.5%? Do you think that the balance is good, or will there be a moment of reckoning between the equity to the bond market?
I think for the last few weeks, as yields have kind of crept higher, I think all they've done is kind of reverted back to the midpoint of, let's call it the 5% that we saw last year, and the 360, 370 that we saw earlier this year, right? So we're pretty much right at the midpoint. I think from these levels, I think it really starts to challenge the narrative that's out there, and I think it hits those highest, growth, kind of longest duration equities probably hardest, which is why, again, I go back to industrials, materials, energy, and healthcare. Those are lower valuation sectors that can still drive earnings in this environment where the economy is doing okay, but they're not as reliant on those rate cuts that the Fed wants and the market expects.
Yeah, well, certainly a nice shot in the arm today is from David Solomon. He's on the tape right now, and that's a blistering bump for Goldman Sachs. We'll keep an eye on that. Samir, thank you very much. With the warning there, Samir Samana of Wells Fargo. Coming up, the former President Trump heads to court.
I think it's generally not a good look for Trump. The bottom line on Trump right now is that he's struggling to try to unite the party.
We're live outside the Manhattan courthouse. That's next on Bloomberg.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
What are you most worried about in the global economy now? Is it the geopolitical environment, U.S.-China, Ukraine? Is it inability to pass the debt limit extension? What are you most worried about?
I think most of the time, I would answer the same way, a financial crisis. As a human, I worry a lot about the Chinese invading Taiwan and World War III coming on. But in that case, I don't think whether you invest with David Rubenstein or Cliff Asness is the really big issue. So I think a financial crisis I worry about because they're very unpredictable. After the fact, everyone predicted them. But before the fact, they're not very predictable. I don't think anyone wants a financial crisis. You think you'll do well, and something happens that boomerangs, and you don't.
Well, as we talk, we've seen Silicon Valley Bank basically go under and have to be bought. And there are other banks that have some challenges. Are you worried about a banking crisis or not so much?
Worried enough to put it on my worry list. I have no special knowledge of banks, commercial real estate and banks that deal in that, maybe a more nerve-wracking place, how that shakes out in cities. So, yeah, those things worry me, but not especially more. I think even before SVB, I would have said financial crisis is a very low probability. When someone says their biggest worry, doesn't mean they think it's likely. It means they think it's possible and would be terrible.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
I think it's generally not a good look for Trump. The bottom line on Trump right now is that he's struggling to try to unite the party, and my prediction is that he won't, and I think can't. And at the same time, he's already underwater with independent voters. He needs a unified party, and he needs a majority of independents to win, as he did in 2016. I tend to think, on balance, this drives people away.
Well, let's see. Donald Trump has arrived in court, and he is set to become the first former U.S. president to face a criminal trial. This comes as the Republican nominee is fighting his battle to retake the White House. Katie Lyons is tracking this story. Trump has arrived, we understand, at the court. What did he have to say?
Well, Manis, he repeated lines that we have often heard from the former president in regard to the many legal cases he is facing. This, of course, just being one of 4 criminal indictments he has faced. On his way into the courthouse, he spoke with reporters saying this is an outrage. This is a political persecution. It's a case that never should have been brought. Of course, this case was brought by Manhattan District Attorney Alvin Bragg, who has charged him with 34 felony counts of falsifying business records related to alleged hush money payments paid to porn star Stormy Daniels in the days ahead of the 2016 election. Trump has pleaded not guilty to all of these charges, and he is right now in the courtroom sitting at the defense table as these proceedings get underway. They are historic, the first time a former U.S. president has ever stood criminal trial, and what they kick off with is jury selection. This could be a lengthy process that could last 1 to even 2 weeks as they try to weed out jurors who can be impartial and fair in assessing the fate of former President Donald Trump, who, of course, is the presumptive Republican nominee. And to that point, Manis, this could have serious political consequence for him. He is required to be here in person at the court every day of this trial, which will be every weekday except for Wednesday. That will keep him off the campaign trail. He is spending a great deal of resources on his legal defense, and potentially, depending on what the verdict is, this could impact outcomes of the vote in November. A Bloomberg Morning Consult poll of swing state voters back in January surveyed across the 7 swing states likely to decide the outcome of the 2024 election. More than half of them say that if Trump were to be convicted of a crime, they would not vote for him come Election Day.
And Kaylee, in terms of how this plays at the polls, it depends which polls you read, but every time the former president appears at court challenging the legal system, how does that play in his campaigning? This is a president who is campaigning and in active campaign mode for the presidency.
Yes, and traditionally, Manis, he has used court appearances like the one today to galvanize his base of supporters, to fundraise, to speak to the press, and do so in a way that is free, not having to actually hold a campaign rally, but using court appearances as a way to get coverage, to plead his case, as he says, basically that this is a weaponization of the justice system in America against him. So he likely will continue to do so. The question is whether this is a time in which that strategy is going to start turning into something that works more against him than for him again, because if he is convicted of a felony here, not only could he potentially face prison time, but it could change the minds of those crucial voters who may alter their opinion of Trump closer to Election Day, depending on the outcome of this trial. And I would note, Manis, this is at this point the only trial that looks like it will wrap up before that Election Day in November. He's facing 3 other criminal indictments, and yet those have been mired in delays. We are awaiting a Supreme Court decision on his immunity challenge to the 2020 election subversion case in Washington that Jack Smith has brought. That will be the next big legal date to watch in that case, which comes up on April 25th. And of course, we'll be in the middle of this trial here in New York still at that time, Manis.
Katie, thank you very much. Certainly another piece of theater for New York. Coming up, sector price action. Abigail Doolittle is with me. Abby, what have we got?
It's a very interesting day here, Manus. We do have a gain of 0.8% for the S&P 500. All 11 sectors are higher. Making it so interesting, of course, is the fact that we have yields spiking sharply higher in that retail sales data. The 2-year yield almost at 5%, the 10-year yield backing up about 10 basis points. So that's pressuring real estate and utilities, given the fact that those dividends look less attractive. Discretionary down as Tesla drops about 2% on the various staff changes. And then financials up the most, up more than 1% on yields higher, plus Goldman Sachs, of course, that terrific quarter helping out the sector overall. So overall, we have strength relative to another pocket of strength. We have United Airlines reporting earnings tomorrow. Into that report, Manus, we do have the airline sector up more than 1% as well. A nice climb here for airlines, all four components of this index, so relatively narrow index. Those stocks are all higher, again, up 1.3% for airlines. Right now, a bit of a risk-on tone. Stocks higher and bonds lower.
Yeah, there's nothing getting cheaper about flying anywhere. Abby, thank you very much. Coming up in the show, market moving events to set your clock by on the Trading Diary. Context matters.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why, part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
This is Bloomberg.
U.S. equity markets have done a full 180 from Friday. Last week was one of the worst weeks in 2024. Here you are setting up for a bid. Despite bond yields rising, retail sales remain strong. Take out the gas, take out the autos and bond. Look at this. We're up 10 basis points now on 10-year government bond yields, and very much at the short end, a little bit less, up 8 basis points. Roll it over and you have a look at one of the splendid stocks that have performed this morning. It is Goldman Sachs. It is on their trading. It is on FICC. The stock is up just under 5%. We have been higher, so we give a little bit back at the moment. Your trading diary looks like this for the rest of the week. San Francisco Fed, Mary Daly speaks tonight at the Stanford Institute on Economic Policy and Research. Tomorrow, more bank earnings, Bank of America, Morgan Stanley. Wednesday, it's the Beige Book, and then the subcommittee on Boeing safety.
top names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to create index products, and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. Alex Steele, Paul Sweeney, this is the Bloomberg Intelligence program. We lean heavily on the more than 400 investment professionals at Bloomberg Intelligence. They cover 2,000 companies, about 130 industries all around the world, and we lean in on their investment research. Coming up today, we're going to check in with Dr. Ariel Cohen, Senior Fellow at the Atlantic Council, talk about the geopolitical implications of Iran's attack on Israel, and then we're going global energy. Ellen Wald, president of Transversal Consultants, she's going to give us a sense of where she thinks global energy prices are going. But first, let's kick everything off with a Bloomberg Business Flash. Lisa Mateo.
You got it. Market Drivers brought to you by Interactive Brokers. Interactive Brokers charges USD margin loan rates from 5.83% to 6.83%. Rates subject to change. Learn more at ibkr.com/compare. All right, stocks kicking off the week on a positive note as new economic data showed some resilience. Also speculation that the Middle East conflict remains contained. And let's not forget earnings season continues. Today we heard from Goldman Sachs. Right now those shares up nearly 5%. Charles Schwab up 4%. And we have M&T Bank up about 6%. So we have the NASDAQ up 0.7%. The Dow and the S&P 500 up 0.8%. The 2-year yield at 4.98%. That's up about 8 basis points. The 10-year yield at 4.63%. And that's up about 10 basis points. To commodities, oil shrugging off Iran's attack on Israel over the weekend. Right now we have Brent crude $89 a barrel, NYMEX crude $84 a barrel, and gold, that's higher at $2,346 an ounce. That's spot gold. And just for that economic data, I want to point out its retail sales rose more than expected last month after an upward revision to February's number. We'll have more on that in just a bit. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa. Really appreciate it. The retail sales, this goes to my point of happy tax day, by the way.
Okay, yes, thank you.
So if you get strong retail sales and then you get your tax refund, you're going to keep spending that puppy. So that maybe that push out.
Speaking of taxes, I saw Mark Cuban with his tweet. He wrote a check for $288 million tax bill.
Wow.
That gets your attention. I guess he had a good year.
Right, so he's not going to get the refund.
No, he's
That's
probably
cool.
not. Okay, yes.
But other people may get the refund
Yes.
and help those retail sales. Happy Monday, happy tax day, all the things.
Absolutely. We got a good tape here to start the week.
We do. Maybe not a great day for President Donald Trump. So the first criminal trial is starting in Monday down in Manhattan. The former president repeating his complaints that the hush money case is nothing but a political attack. There are some pictures, though, of the hubbubaloo down on Center Street as he enters the courtroom. Tons of news there. We have satellite trucks, the whole thing. And one of those people is Kelly Lines. She is co-host of Bloomberg Balance of Power, and she joins us now outside the New York City courthouse. All right, Kaylee, what's the latest?
Well, right now there's a Trump truck going by with flags and the like, blasting music quite loudly at this row of reporters that is here to cover what really is a historic day, Alex. This is the first time in U.S. history that a former president has been put on criminal trial. Trump, of course, in this case is charged with 34 felony counts of falsifying business records tied to hush money payments made to porn star Stormy Daniels in the days ahead of the 2016 election. He, of course, denies all of these charges, has pleaded not guilty, and made his feelings known walking into the courthouse today about how he views this as political persecution. Now, what's going on inside the courtroom at the moment as Trump sits at the defense table is that the judge, Juan Merchan, has taken the bench and said that there are some loose ends they need to deal with before jury selection, including a motion for recusal. So they'll deal with that first, and then they're going to begin the process of trying to select a 12-person jury with 6 alternates, trying to weed out who can be impartial and fair in assessing not just a former president of the United States, but of course current presumptive Republican nominee.
Kaylee, how long is this trial expected to last?
Well, jury selection, Paul, could take between 1 and 2 weeks. The trial in its entirety could be 6 to 8 weeks. So realistically, we're talking a period of maybe up to 2 months here, which is going to impact Trump's ability to actively campaign for president. He has to be here physically in court every day of this trial, which will take place every weekday aside from Wednesday. So it's going to take up a great deal of his time and a great deal of resources as well, potentially millions of dollars that needs to be spent on his legal defense, which can take out of some campaign funds that otherwise would go to political advertising and the like. Traditionally, though, Trump has been able to use these court appearances to really use the media attention to plead his case and, frankly, to treat them as campaign stops. And historically, these court appearances, all of his legal troubles, have had the effect of galvanizing his base. He's proven the ability to fundraise off of these legal challenges. There is the question, though, of whether or not he's convicted in this case. If he actually is guilty of crimes at the end of this trial, according to a jury of his peers, that could impact voters' opinions of him and their willingness to vote for him come November. A Bloomberg Morning Consult poll we conducted in January in the 7 key swing states likely to decide the outcome of the election found that more than half of voters in those states said they would not vote for Trump if he were convicted of a crime.
Kaylee, amazing work with all that background noise. Was that like a regular honk, or was that like the Trump bus?
There's honks, there's horns, there's drilling, there's people screaming on occasion. There are protesters here, both for and against Trump, so definitely a noisy day here in Lower Manhattan.
We love the Nat sound. Fantastic. Kaylee, thanks a lot. Kelly Lyons, co-host of Bloomberg Balance of Power. Back to the market here. You're looking at S&P up by about 0.7%. Yields also pushing much higher as well. Now, Friday, the S&P kind of closed right on its 50-day moving average. We're all obviously rebounding from that today, and I'm just wondering, like, what are we learning in terms of price action? So no one better to talk to than Abigail Doolittle, Bloomberg News markets reporter. Abigail, what did we learn about markets reaction function, investors reaction function over the last 2 days?
That it's in line with what we've seen actually for a few months. And the reason I say that is while the S&P 500 hitting on the 50-day moving average for the first time last week, the NASDAQ 100's been doing that for a little bit longer. And both of these indexes have been making new highs while the momentum is going back down. This divergence, this bearish divergence, is worse than ever. December. So that's a continuation of that trend. In addition, for both of these indexes, and this is a little bit new, we haven't had a higher high in just a few weeks. So investors growing more cautious as we go down on the 50-day moving average. The question is, are we going to see the near-term buyers step up and send these indexes higher, or is that bearish divergence, the less momentum, is that going to tell us that we're actually going to see some sort of a move down for bigger consolidation toward, let's call it the 200-day moving average, the long-term buyers?
I think what's clear in this market, we don't need Apple to lead this market higher. You know, it had that pop, you know, on Friday or last week with the, I guess, the Macs, and talking about AI being more incorporated into their Macs, but it's knocked down again today.
Yeah, that's a really interesting point, and this is actually not something new too. I think that Apple is one of the main reasons that we have had the RSI and the S&P 500 and the NASDAQ 100 going down since mid-December. That was Apple's last peak, and what I'm doing right now is checking to see whether or not Apple is no longer the second major weighting for the S&P 500, because at some point something's going to have to give. No, Apple still is. So Microsoft 7.3%, but Apple at this point just 5.87%. NVIDIA not so far behind. We may soon see, if NVIDIA continues to climb and Apple goes down, Apple become the third largest player within the S&P 500. But again, for it to be such a major mover, this is a member of the S&P 500 and the NASDAQ 100. At some point, those indexes are either going to have to truly fall, and I will say over the last 2 weeks, that's certainly a piece of it, and again, going back to that weakening momentum over the last few months, or we're going to see Apple just decline in importance in terms of both of the indexes.
And of course, that news of why Apple is declining is that shipments for iPhones slid worse than projected 10% in the first quarter. This is according to IDC. One silver lining, though, apparently, average selling prices for handsets are rising because everyone wants the fancy, expensive phones.
Okay.
In theory, that's a sign for Apple in terms of maybe margins.
Margins, yeah, I would say margins.
I'm definitely digging. Here's my other question: is the big rise we're seeing in yields? Paul was pointing out earlier the 2-year really kissing that 5%.
Yes.
And just the continued strength of the economy allows equity investors to ignore higher rates. And I just wonder when that comes home to roost.
They can try to ignore it, but at the end of the day, it's going to be the Fed that controls everything. We've talked about this before. As the Fed giveth, you know, it happens, and if not. So if the Fed does not, in fact, cut this year, or cuts less, or cuts further out, as a lot of the inflation data recently would suggest, I think that equity investors are going to be coming to terms with the fact that, yes, it's a solid economy, but it's a little bit too warm, at least, possibly even hot, for the Fed to cut, and that means that new liquidity isn't coming back in. So it would have to be a really strong, steady push higher for the economy, where it's, I don't even know what that would be, I don't even think that's a soft landing. That would be a no landing Goldilocks scenario for the Fed, where rates being where they are does not create a problem for liquidity. But the longer this goes on, and from a commercial real estate and a real estate standpoint, from a stock standpoint, because at some point the gains in stocks are going to flow into the economy and then potentially overheat things. So it's really this cycle that we're all watching. Right now, though, I don't think that a strong economy can really help investors offset the Fed if they don't cut this year, or cut less.
All right. Abigail Doodle, thank you so much. We really appreciate it. Abigail Doodle, she covers all the markets for Bloomberg. We appreciate getting a few minutes of her time here in our Bloomberg studios here in Midtown Manhattan. Let's pivot to the geopolitical front, because another busy weekend in the Middle East with the Iranian attack on Israel response. Dr. Ariel Cohen joins us. He's a senior fellow at the Atlantic Council. Dr. Cohen, thanks so much for joining us here. How would you characterize the, I guess, the Iranian-backed attack on Israel over the weekend? How would you characterize it?
First of all, it's an overt act of war. Israel was attacked with 300 missiles, ballistic missiles, cruise missiles, and drones. The systems worked very well, both in CENTCOM, U.S. Central Command, that Israel was joined several years ago. That was the right decision to integrate Israel with its Arab neighbors. And the U.S., UK, France, Saudi, Jordan, and apparently UAE all participated in shooting down the Iranian missiles. But this is just a first try by the Iranians, an unsuccessful try. The largest drone and missile attack of the 21st century. Both the Americans, the Israelis, and the Iranians, the Russians, and the Chinese are going to learn, do lessons learned from this. and probably move to program to plan bigger and worse strikes against each other. We saw many drone attacks in Ukraine. And one of the lessons learned is that massive drone attacks, the swarms of drones, as we saw, can be countered. So that's the good news. The bad news is the Iranian regime is dead set on destroying Israel. The chant every Friday in Tehran is death to America, death to Israel, and they will continue on their merry way.
So, Dr. Cohen, the question yesterday was, is this the start of a direct war between Iran and Israel and its allies, or was Iran's attack calibrated and telegraphed retaliation? It sounds like you're in the former camp of that.
The direct war of Iran against the U.S. and Israel is going on since the days of the founder of the Islamic Republic, the Ayatollah Khomeini. You remember the American CIA station chief was kidnapped and tortured and then murdered in Lebanon in 1983, Colonel Buckley. And one way or another, I was covering or studying these events now for 40 years. So it's an ongoing war, but this was an escalatory operation. And this is the Middle East. Israelis, sooner or later, will have to retaliate, even as President Biden is telling them to step down and take a win. When you have 300 missiles lobbed against your country, this is not going to stop there.
So, Dr. Cohen, what do you think Israel's response will be and or should be?
I think that as Israel has ongoing business in Gaza, in the northern border against Hezbollah, in Lebanon, they will not be able to launch a large-scale attack against Iran. They shouldn't, not right now. But they have other tools. They have cyber. They were very successful with cyber attacks against the Iranian nuclear program. And they have other means to disrupt the Iranian military establishment and the Iranian economy.
Will this sidestep, in many ways, containment of Russia? So I follow the oil markets, and there is a narrative out there that, you know, if you wind up moving deeper into sanctioned territory or even enforcing the sanctions that are there on Iran, that opens up an avenue for Russia to sell more oil and make more money. How does the U.S. weigh these two events?
Well, let me connect this to something the Biden administration just recently did. They put a freeze on our LNG development going forward. And I think when we have malign actors like Russia, like Iran, who are oil exporters, we, the United States, Canada, and others need to produce more, not less, oil and natural gas for the market.
All right, Dr. Cohen, so I guess one of the questions here as we think about next steps is the position of Mr. Netanyahu within Israel itself. How is his grip on power? How is his ability to continue to move forward with this, this conflict?
Well, I was in Israel during the attack. The morale is high, but people are sick and tired of Netanyahu. If the elections took place today, he would lose. And his credibility is shot, both because of the criminal investigation that predate the Hamas attack of October 7th, and because of the huge, unprecedented failure of the Israeli intelligence and the military on Netanyahu's watch. So he may be trying to distract the attention to move on towards the Iranian confrontation. I do not want to speculate, but I think sooner or later, Israel will do the right thing. There'll be a judicial commission of inquiry like there was after the Yom Kippur War of 1973, when Israel also got a huge strategic surprise 50 years ago to the day of the attack of October 7th. And after that commission of inquiry, there will be consequences for Netanyahu, up to and including criminal proceedings I don't want to speculate right now, but he is politically a living corpse walking.
All right, Doctor, thanks a lot. We really appreciate Dr. Ayla Cohen, Senior Fellow at the Atlantic Council, has had extensive experience, 20 years. He served as Senior Research Fellow in Russia and Eurasian Studies and International Energy Policy at the Heritage Foundation. Wonderful to get his perspective. I think what's interesting, Paul, for the markets is how do you hedge the unthinkable? Yep. Like going into Friday, it's like, okay, you don't want to take risk into the weekend. You want to take some safety. But now how do you do that?
Exactly.
Like, do you sell puts? Like, I don't know.
Well, some folks are selling oil here. Brent crude down about 1.7%. Still, up around $89 per barrel, but maybe a little bit of a sigh of relief a little bit there.
Oh, absolutely. And also, there's some narrative out there like, why would Iran want to hurt themselves even more on the oil front? Anyway, we'll discuss. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've had more economic data out today. Retail sales rose more than expected in March, rising 0.7%. The prior month was also revised higher. Now, when you take cars, gas out of the picture, blew past expectations, rising about 1%. New York Fed President John Williams says he still expects the economy to grow just a little bit more slowly. He added that the central bank will likely start lowering interest rates this year if inflation continues to gradually come down. We shall see. Over to the stocks right now. The S&P 500 rebounding after posting its biggest weekly drop in 2024. Right now, it's up about 0.3% at 5,140. We'll head over to the NASDAQ, up about 0.1% or 25 points. The Dow up 0.5% or 162 points. Financial shares also driving gains. We have Goldman Sachs adding about 5%. NVIDIA, that's leading mega caps higher. Over to yields. We have the 2-year yield at 4.98%. That's up about 8 basis points. The 10-year yield at 4.65%, and that's up about 12 basis points. The currencies, we have the dollar stronger, Japanese yen, euro weaker, British pound is stronger. Bitcoin up about 2% at 65,486. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo, joining us there. This is Bloomberg Intelligence Radio. Happy Monday, happy tax day. I'm Alex Deal alongside Paul Sweeney. We are live from Interactive Broker Studio right here in Midtown Manhattan. Looking at the crude market here, you're looking at Brent down by about almost 2%. Same for WTI. So you're now at 88 for Brent, about 84 for WTI. So kind of what's next? Ellen Wald is president of Transversal Consulting, and she's a great person to talk to on the price and fundamentals, as well as the geopolitical risk. Just a handful of guys who do that really, really well. Ellen, it's great to get your perspective. I've gotten so many notes from strategists this morning on sort of what's baked in now to the oil price. What's your call? What geopolitical premium is in? How much should be in?
I think there's definitely some geopolitical premium that is baked into oil prices, but I think it's been that way for some time now. I think that because this attack happened over the weekend, the price action was really, really muted, even more than it would have been, it was otherwise, considering that there was no oil supply that was involved or threatened in any way. And so we didn't even see any, potential ups and downs or brief spikes just because there was no trading going on. I think the question really is, now that prices are kind of backing down, what's the next step? Where are things going? And if there are any indications that Israel is going to launch further attacks against Iran, or there could be more retaliatory attacks from Iran, I think that could definitely cause oil prices to go up, maybe another $1 or so. But we'd have to get some really strong indications that something incredibly major or explosive would happen in order, I think, for oil prices to really spike higher and stay higher for longer.
Ellen, talk to us about the demand side of the equation. Before October 7th, that seemed to be the driver here of global oil prices, the ups and downs of global demand. What are you seeing in terms of demand these days?
Yeah, what we're looking at is, we did see some pretty strong demand in the United States. Gasoline demand is not quite as strong this week as maybe it was in previous weeks. But when we go, looking towards the summer, I think we're expecting to see pretty strong gasoline demand over the summer in the U.S. and also what's going on with Asia, especially with China, because they're big drivers of demand as well. And I think we're seeing some reluctance in Asian buyers to buy oil or to order more cargoes from the Middle East, because there's a concern about whether it will get there. And that's actually fueling demand for American oil, which could actually either push up the price of WTI or keep it a bit more elevated as opposed to coming back down as the geopolitical premium goes down. So I think that it's kind of a complicated picture and does depend obviously on the economic situation globally. If we see some kind of more recession, we could see demand falter, but right now it looks pretty strong heading into the summer.
Which brings us back to the supply picture, Ellen. So when you were talking about stronger action from Iran, the elephant in the room is closing the Strait of Hormuz, where a lot of oil passes through, and that would be a huge line in the sand for oil and would cause unbelievable spikes in the oil price. What is Iran's capacity to actually do that? Because they've gotten kind of a good gig under President Biden in terms of, their exports are up, right? Their oil exports are up. Do they really want to mess with that?
Exactly. And I think the only case in which Iran takes any kind of action to shut the Straits of Hormuz to shipping. And so remember what we're talking about is this is a small passage, and Iran could could do this in a number of ways. It could either block it with ships, or it could fire missiles off of nearby land that could make it impossible for ships to traverse this area. But for them to really take that action means that Iran has nothing to lose, because if Iran cuts off other ships' abilities to go through that, then you're going to see the U.S. Navy cutting off Iranian ships' ability to come through the Straits of Hormuz as well. So Iran really has to have nothing to lose. And right now, it's got a lot to lose. It's got a very thriving contraband oil industry going on. It's making a lot of money. And as oil prices go higher, even though Iran has to sell its oil at a discount, it's going to make more money. So it doesn't want to mess with that. In fact, it probably wants to sell more oil to its buyers as opposed to less. So if Biden starts to mess with that by enforcing sanctions harder, then that could kind of stir things up and make things more tense. But right now, unless Iran's oil industry is shut down, is to say if its oil industry was destroyed, then it might have the motive to do that because it's got nothing to lose.
But it's definitely not there yet. I mean, just for perspective, like in March, Iranian oil output hit a 5-year high, about 3.25 million barrels of oil a day. And the conversation we were having earlier with Dr. Ariel Cohen was, if sanctions are lined up heavier on Iran so they can't export that much, that opens the door for Russia to start selling a little bit more as well. So talk to me about how you balance, as someone in the Biden administration, how do you balance those two? How do you do that?
Well, I think the Biden administration also has to come to terms with the fact that its price cap policy on Russia is basically a failure. It's not really stopping Russia from making money on its oil industry. So yes, if Iran has less to offer, then Russia can fill in those gaps. But I think there's also the issue of Russia's participation in the OPEC Plus output cuts. And if come June, oil prices are still in the 90s, then there's going to be a lot of pressure on OPEC to raise its output. And Russia's part of that. And Russia would love to sell more oil, obviously. So this whole thing is a very complicated dance. Meanwhile, the Biden administration is going to want more oil on the market because it doesn't want high gasoline prices going into an election year. So they both want Russian oil on the market. They just don't want Russia to make a lot of money off of that oil. But it seems like they can't really have both of those things.
Well, Torsten Slok over at Apollo Management put out a chart today that, for me, who's not an oil expert, was really illuminating, which is saying the U.S. is the biggest oil producer in the world with about 12.9 million barrels per day. Why don't our friends in Texas and Oklahoma just start pumping out more oil here?
Great question. And the answer is that this is not the same oil industry as it was in 2015, 2016, 2017, where it was all pump, 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 drill, 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 put out as much as you can. Don't think about what you're selling it for, the returns. It's just growth, growth, growth. That's not the oil industry now. There have been a lot of consolidations. Oil companies are running very lean games. They've really cut out a lot of fat during the pandemic, and they're at a point where they don't have to produce. They don't have to grow in order to satisfy their shareholders. They're sitting very well. Sometimes they may drill more wells, but it's become much more expensive. Inflation. We all think about oil prices causing inflation, but what we don't often think about is how inflation acts on oil production. And so everything costs more to drill now. And so they may see a benefit in not expanding drilling so much. They are increasing production by getting more out of every well, but there isn't necessarily a benefit to drill when they've got a good thing going right now, and it's becoming more difficult to drill more in terms of the prices, the supplies, and all of that. So and there's less incentive for them to do that at the moment.
All right, here I'm going to go all oil nerd on you, Paul. Nice. Right? Okay, all oil nerd for you. The U.S. produces a different type of oil than the oil you're going to get in the Middle East.
Sweet crude.
Yes.
Yes.
Light sweet crude.
Light
okay.
sweet.
Light sweet. Hey, John Tucker. We were just talking about gasoline prices. It's very sad for you.
Just real quick, boil, B-O-I-L,
It's a great function.
All the different types of oil. It's like 60 different types of oil.
And all of them have different qualities, and you can use them to refine into different kind of products. So even if the U.S. was producing like 40 million barrels of oil a day, which obviously is like not possible, it wouldn't make up for the loss that you'd see in some of the Middle Eastern countries because they have the heavier stuff, which is really good for other products. So that is your Alex Lane of the morning. You are so welcome. Ellen, thank you very much. Ellen Wald, president of Transversal Consulting, joining us there. There was also an interesting article, I think it was in the Journal, that U.S. oil executives finally have a direct line to the White House, that like now their calls won't be rejected and they actually can go and talk to the Biden administration. So that was quite interesting. Oh, yeah. Like a few years ago, when first time gasoline prices went to $5, I asked a CEO of a major oil company in the U.S., has the Biden administration called you? He's like, not even tried.
Wow.
Yeah, but now that may be changing a little bit, so there you go.
I would think so. I mean, we need our oil and gas industry as well as we need the green stuff too.
I debated about this with my husband yesterday on the car ride home. Yes.
Wow, that must have been a fun.
It was a fun convo. Here's John Tucker with more fun convo. World National News.
All right, thanks to Alex and Paul. As jury selection gets underway in New York this morning, former President Trump addressed reporters from inside the courthouse, calling his criminal trial a political persecution and something he says should never have been taken up.
It's a case that should have never been brought. It's an assault on America, and that's why I'm very proud to be here. This is an assault on our country.
The trial before Justice Juan Merchan expected to last 6 to 8 weeks, though the process of selecting the jury, that could take 2 weeks or more. Former President Trump, the presumptive Republican nominee, required to attend the trial just as the campaign for the White House is heating up. Iran says it considers its attack against Israel concluded. We asked White House National Security spokesman John Kirby if Israel feels the same.
The War Cabinet is still deliberating and making their decisions. The president had a very good conversation with the prime minister right after or towards the end of the attacks on Saturday night. And the president was very direct that this was a huge success, that Israel can be proud that it doesn't stand alone and that it has superior military capability. Iran utterly failed in what they were trying to achieve, and that success alone sends a strong message to Iran and to the region about Israel's place there.
White House National Security spokesman John Kirby says Iran failed utterly in its objectives. And the Food and Drug Administration's drive to get new drugs to patients quickly causing problems. A Bloomberg analysis shows one ALS drug made $400 million in sales for its maker. It doesn't work. A cancer treatment brought in $500 million for one other drug maker. That turned out to have no effect whatsoever on survival rates. Global news 24 hours a day, whenever you want it with Bloomberg News Now. I'm John Tucker. This is Bloomberg.